The demand for stocks remains very healthy.
When there's a lot of enthusiasm, people tend to get a little bit ahead of themselves.
If that falters, I think we've got a real problem on our hands.
You have to be prepared that this could shift, and it could shift very, very quickly.
The summer's going to be volatile.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get Bramo to the weekend. Live from New York City this morning. Good morning, good morning. Let's get me to the weekend.
Thank
For
you.
our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday within 1% of all-time highs. The tech rebound sending stocks towards a second straight week of gains, leaving the equity market wide open for SK Hynix to raise more than $26 billion. Just as fixed income investors are becoming more discerning, S&P downgrading Oracle to one notch above junk.
Just want to say thank you for correcting the record that it wasn't just me. I think a lot of people are looking forward to the weekend. One thing that's notable is, as you're pointing out, this is a market that can walk and chew gum at the same time. It just isn't very graceful. You can see right now the outperformance once again reasserting itself from big tech, even as people are with their eyes wide open. They understand some of the risks, perceiving them with respect to Oracle, understanding that if you are spending more than the cash flow is offsetting, all of a sudden it becomes a little bit more of a concern about that long-term AI investment. At the same time, still pouring money, the biggest foreign debut for a U.S. IPO by SK Hynix on record.
Just to take a step back, a little bit of a breather and think about framing the week. Bit of pushback to an Amazon debt offering, arms wide open to an SK Hynix equity offering. And on the debt side, the questions are different. When we spoke to Vishal Kandudra of Morgan Stanley earlier on this week, he said it pretty clearly that the hopes and dreams will get paid in the equity market. We won't get the upside in the debt market. So show me the yield. And I think that's part of the pushback. You want to raise the capital over here, need to pay up.
The pendulum is swinging just a touch back to debt investors having a bit more leverage. You're seeing equity investors still really believing in the upside story. This has been happening slowly over a period of time. It isn't just happening, though, in the AI trade. And this is what I find interesting. You also see this in the government debt sale side of things as well. You see people in the bond market saying, we have lots of cash, we want to put it to work, but we want to get paid. This is a new dynamic. This is not a market cracking. This is not a market breaking down. This is a market being more discerning, and a lot of investors seeing the opportunity to get more money.
It's a market repricing. The competition for capital continues. More on SK Hynix in just a moment. I want to talk about Japan. We should all talk about Japan. The Japanese government just giving the pension fund a bit of a nudge here. The finance ministry, to be specific, to bring the money home. Yields down across the curve at the long end, down by more than 10 basis points. This is the $2 trillion beast, almost $2 trillion beast, potentially sparking the great repatriation trade. The takeaway this morning, it'll take time.
What a lot of people are looking for is just how broad the implications are. Look, this was the finance minister in response to a question saying that there should be a policy, or there will be policy, to support the repatriation of assets in Japan. It led to this rally in some of the Japanese assets. It also has implications for U.S. treasuries and for other assets around the world, because that's where the Japanese money is currently. So do you start to see actual policy prescriptions to ease the pathway to make that happen? Is this verbal intervention? This was clearly prepared, even though it was a response to a question.
We'll take a beat on that particular topic in just a moment. Fantastic guest coming up. Equity futures this morning erasing this morning's losses and heading towards another week of gains. S&P 500 futures down by not even 0.1%. Coming up this hour, we'll catch up with George Goncalves of MUFG with equities on track for a second week of gains. Jing of Morningstar as SK Hynix launches the largest ever foreign debut in the US. And Juckes of SocGen as Fed Chair Kevin Warsh names his new task force leaders. We begin this hour with stocks inching lower following a chip-led rally. George Goncalves of MUFG writing the inconsistencies in various market metrics will be ironed out, helping bring back convictions into the fall. George joins us now for more. George, good morning.
Good morning.
What do you have convictions about this Friday morning?
I have convictions that it's Groundhog Day every other week. We have a bond market that always goes to 4.5 in the 10-year, 5% on the 30-year. You get tech stocks kind of rebounding, and you get all-time highs, but we're kind of stuck in nowhere's land.
Yields are range bound, 4.2%, 4.1% on twos at the front end of the curve. We've seen that quite a few times, but there is an aggressive push from both corporate America and a tech trade worldwide to raise capital in this market.
Yes.
We started the show by talking about the distinction in the equity market and the debt market right now. What do you see?
Yeah, look, I think it's interesting. If you actually take from an upside-down pyramid perspective, there has been dispersion within leveraged loans. There's been dispersion within high yield, but IG has been very homogeneous. It's been very, very tightly knit. Almost every spread kind of tracks the overall index. You know, if there's going to be more kind of discerning nature coming from the credit investor world, well, we should start seeing it in IG. IG is way too tight, and there should be some sort of concession given all the capital has to get raised.
So do you think there's any takeaway in some of the spread widening, at least in the new issues in the bond market, versus the robust demand for some of the equity offerings? Do you think the pendulum is shifting more to the bond investors? Do you think bond investors are getting a little bit more wary about a high-yield environment more broadly? What's your take on that?
No, I think your opening remarks were spot on in the sense that yeah, now you have to kind of pay to play. And so I think that aspect is going to be with us. But it's been an amazing year so far, a lot of issuance. But in the second half of the year, if there's a lot more capital raising that's needed, I think the yields and spreads are going to have to widen to facilitate.
When is spread widening the window closing? And this is the distinction that we're having trouble understanding, because at one point it was investors pushing back could potentially curtail some of the spending ambitions of big tech. At this point, it's going to cost them a little bit more. Is there a tipping point where suddenly it becomes a constraining factor?
I mean, given the sort of estimates for revenue potential, if you pay an extra 10 basis points, that's really not going to move the needle. I think it really starts to matter when you have bigger moves. And it's going to be a function of both, like bond market volatility as well as spread widening that's going to really, maybe not necessarily curtail credit availability, but might kind of close down markets. And that's where you get nervous around the fall.
We should know we're picking up on small signals here. Getting deeper into the summer, it's still quite snoozy. 260 on high yield spreads, which historically, as you know, Lisa, better than most. Incredibly tight. It's
incredibly tight. When you take a look at bond market volatility, it is absolutely nowhere. So when people start saying, well, it could get more volatile, it's not getting volatile in any way, shape, or form, either in bond or overall stock index level types of metrics. So again, not necessarily screaming warning bells.
Step up, Kevin Walsh. Does Kevin Walsh make things more volatile? The reluctance to communicate, to provide forward guidance?
Well, I do think that it's kind of refreshing that we're taking the opportunity to kind of slow things down a little bit. I mean, perhaps we've had over communication in some angles, right? And so I think it's good to see kind of a rethink about the communication strategy. I mean, the 5 task force are now fully in motion. I think it's an opportunity to kind of rethink what is the appropriate policy, like how to communicate with markets. And markets, the bond market's a sophisticated group of individuals. We can discount things too. We don't have to be kind of handhold.
At the same time, to the degree that we are hearing anything, it is increasingly hawkish. Even New York Fed President John Williams yesterday came out, and he has been actually pretty dovish for the past couple of meetings, and he came out sounding really hawkish, saying that the inflationary problem is not necessarily just tied to oil prices, but AI is his bigger inflationary concern. Are you starting to change your perception of the reaction function at a Fed that has no doves left?
I'm not sure if it's no doves left. I mean, I think people are kind of falling in line. I mean, you heard it even last week at Sintra, and the idea that we want to reduce forward guidance is now becoming a theme amongst all central bankers, both here and abroad. I'm not sure if it's dovish. It's just that we're used to having too much information, so that anything less than that is going to be viewed as hawkish. Maybe they're just kind of letting us figure things out on our own. I'm not thinking that's a signal per se.
Two's at the moment close to 420. That is still a decent gap above where policy rates are right now. Max Kettner of HSBC is still quite bullish on equities and overweight risk more generally. And he points out that it will be difficult for this Fed to out-hawk market expectations. I think that's an important question. How hard will it be for this Fed to out-hawk what is already in the price?
Yeah, well, the thing is interesting. I mean, what does out-hawk mean? When you look at the WIRP page on Bloomberg, you have the market pricing in one hike and then followed by cuts. That, to me, looks like risk management. It doesn't look like a market that's really that hawkish. They're just scared of this unknown that there may be a risk of a hike. I don't buy it.
Do you have a base case if you don't buy it? What do you buy?
So we think that the Fed's on hold, and in fact that they're going to end up coming back to square one, which is that neutral still is somewhere close to 3%. And at the end of the year, this is going to be a big exercise in just kind of figuring out that we're coming back towards 3%.
I want to go back to where John began the show when he was talking about Japanese bond yields and the fact that you did see a rally into them, and this question around Japan being the big repatriation trade that hasn't happened for about 20 years. This does seem like it is potentially a bazooka later in the year, should there be true policy efforts to support Japanese investment firms bringing back their investment thesis to their home country. Is there any teeth in this?
I mean, look, the Japanese, both investment base, a banking system is so integrated with the U.S. economy on so many different levels. It's very difficult to see like a wholesale kind of repatriation. But we all know that it's on the margin that prices are set, and so it really comes down to like how much how much capital could come back to Japan, or is it more a function of there's going to be less capital leaving? I think it's more about the capital will stay at home and look for the higher yields within the Japanese bond market and the Japanese banking, like regional banks, the pension systems. They can allocate more there. Yields are more attractive.
Do you think markets will achieve that without it being mandated?
I think at the right price, there's people will be interested.
Close to that right price.
I think we're close to that right price. I mean, and that's why we have a pretty decent reaction overnight, just on one headline, and you see the Japanese bond market favorably moved over 10 basis points.
If less money's leaving Japan, that means less money is available to buy into some of the issuance in places like Europe that the Japanese have turned up to buy. Where do you think it's vulnerable if you do start to see that turn?
Yeah, that's a great point. I mean, I think that the U.S. bond market, left to its own devices, will be fine, and we'll be able to find capital. I'm more worried about the smaller markets, even emerging markets that benefited from carry-type trades. Like that's probably would be more at risk.
George, it's good to see you. It's always good to catch up. Yep. Thank you, buddy. George Goncalves there of MUFG. You're reluctant to make too much of a big deal about what's happening in Japan because I feel like we've talked about it so many times over the last 10 years.
Can you do verbal intervention that's successful without following through time and time again? And ultimately, the Japanese finance minister is doing an incredible exercise in verbal intervention. Or there'll be the follow-through where we get details about how they're exactly going to support this.
The move in dollar-yen did not hold off the back of those headlines, that's for sure. Equity futures right now in the S&P just about unchanged. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more.
Good morning, John. The US and Iran are resuming peace talks even as they exchanged strikes earlier this week. A US official telling us here at Bloomberg the talks are at the technical level and saying the US is aiming for a permanent peace agreement by mid-August. SK Hynix raising more than $26 billion in its ADR offering, the largest ever U.S. first-time share sale by a foreign company. It sold nearly 178 million ADRs for $149 each. They'll begin trading on the Nasdaq later today. And do tune in to Bloomberg at 10:30 a.m. for Ed Ludlow's interview with the chairman of SK Hynix. Fed Chair Kevin Warsh announcing the leadership of 5 task forces to examine the central bank's approach to key aspects of monetary policy. The leaders include prominent academics, former central bankers and corporate executives. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. We'll have more on that story a little bit later this hour. Up next on the programme, pressure rising for a deal.
To me, I think it's over.
We just hit him very hard. I'm not sure I want to make a deal with him. Let's just finish the job.
But reportedly, the talks are ongoing. Stephen Cook of the Council on Foreign Relations joins us next. Live from New York City this morning. Good morning. Heading towards a weekly gain on the S&P this morning. Some muted losses, down by not even a tenth on the S&P 500. On the Nasdaq 100 this morning, down by a third. The money going back into tech, more recently semis in the last 24 hours. Lisa Shalett of Morgan Stanley joining the programme later on this morning. Lisa Shalett pretty punchy about getting out of semis and into hyperscalers. Let's switch up the board and get to the bond market. 2s, 10s and 30s. 2s and 10s, yields bleeding higher through much of the week. This morning down a basis point, still close to 420 on 2s, 450 on 10s, 5% on 30s. How many times have you heard me say that through the week? A range-bound bond market. In Japan, nothing range-bound about it. Big bid coming into the long end of the curve in Japan. A conversation in Japan about the pension fund investing at home. This could spark a major rally in Japanese assets. Yields are lower. Dollar yen a little bit stronger off the back of these headlines, but still Dollar yen down by just 1/3%. So I stress only a little bit stronger.
Yeah, if you're waking up and you're wondering what were the comments that actually did spurk this move, it is this from the Japanese finance minister. One priority is to encourage households as well as pension funds, including the GPIF, to increase their investment in Japanese financial assets. We intend to pursue policies that support that objective. No more details, no more rhetoric. This was in response to a question in a routine press conference. People taking this as signal that they will follow through on something, and that is what's led to such a rally in the bond market.
Let's see if they do indeed follow through. Let's see if markets, just through price and yield alone, keep the money at home. Let's turn to commodities this morning. Brent at 76, WTI at 72. Did you see oil production in UAE?
It was a record.
Record high.
Absolutely amazing.
Supply coming back online.
And it shows how UAE has broken away, as they have said, listen, we're out of OPEC and we're going to do what we want. But it also highlights how much supply has really offset some of the lack of what's going through the Strait of Hormuz. It explains why it's been such a difficult trade to get right. Why it's like the ultimate widowmaker trade. Try to bet on oil.
Yeah, we often say on this program, if you want to make a fool of someone on Wall Street, ask them to forecast crude. It's kind of the story of the last few months, isn't it? Where are we then? Strikes continued through the week. Talks reportedly ongoing. Under surveillance this morning, pressure rising for a deal.
To me, I think it's over. I don't want to deal with them and with this scum. As far as I'm concerned, it's over.
We just hit him very hard. He did a little something today, but it was really retribution for last night.
I'm not sure I want to make a deal with them. We can play games, but I'm not sure I want to make a deal. Let's just finish the job.
So here's the latest this morning. Sources telling us here at Bloomberg, technical talks between the US and Iran are ongoing, following renewed hostilities this week, threatening to shatter fragile negotiations. Joining us now from Washington, Bloomberg's Tyler Kendall. Hey, Tyler.
Hey, John, good morning. Well, this White House official reiterated to us that the White House remains committed towards a diplomatic solution, which could ease fears that this conflict is headed back towards an all-out war amid what was such significant escalation earlier this week. That is in line, though, with our analysts at Bloomberg Economics, who say that this recent bout of fighting follows a, quote, familiar pattern where both sides are trying to gain leverage at the negotiating table. Because going into this week, we already knew that talks were set to slow in some regard, as Iran held several days of funeral rites for the former supreme leader who was buried yesterday. But what feels markedly different now at the end of the week is that the U.S. removed that key waiver, allowing Iran to sell its oil to market, as the Strait of Hormuz still remains the top point of contention and the top focal point. Overnight, we heard from CENTCOM disputing Iranian media reports that the country has control over the strait, confirming that the U.S. military has helped to transit through more than 800 commercial vessels and more than 380 million barrels of oil since May. But, John, even as more supply comes online and we've seen this progress, it is being threatened. New this morning, we heard from the International Energy Agency, which said that these renewed hostilities risk derailing efforts to rebuild depleted global oil inventories when it comes to their projections for the end of this year.
Those inventories in some places have been plunging. Tyler, thank you. Tyler Kendall in the nation's capital. More from Tyler later this morning. To build on this conversation, Stephen Cook of the Council on Foreign Relations writing, the president was insistent on a return to the status quo and the Iranians were not willing to go along. There will be pressure on the White House to return to negotiations. Stephen joins us now for more. Stephen, welcome back to the programme. The president's own words, let's just finish the job. What does finishing the job mean at this point?
Well, it's unclear what finish the job actually means and how they would accomplish that. Finishing the job would essentially mean forcing the collapse of the Iranian regime, which I think the president has come to the determination is not really feasible. So this seems like bombast, trying to shape the behavior of the Iranians at the negotiating table. I'll point out that American strikes have gone further than they have before, hitting some infrastructure as a warning to the Iranians that should they continue to fire on shipping along that U.S. naval declared safe zone in the Strait, they'll pay a heavier price. I think this is all about negotiations. I don't think the president is returning to full-on combat with the Iranians, who refused to capitulate during the most intense phases of Operation Epic Fury.
Stephen, how do you get negotiation between two parties who profoundly do not trust each other?
Yeah, this is a real problem. And this is essentially a negotiation about the Strait of Hormuz. And I think the Iranians have made it clear that in the language of the MOU talks about arrangements for transit through the Strait of Hormuz. And they see that as their administration of it. It's a geographic power that they've discovered as a result of this conflict. And they're not willing to give it up, which is why they're firing on ships that are being guided through the southern route of the Strait. The United States wants to return to something more akin to the status quo that existed on February 27th. There is huge differences between Iran and the United States on this issue. It's not quite clear to me what these technical committees are talking about, given this gulf between Iran and the United States on the Strait.
From market's perspective, they're not exactly looking for some sort of wholesale, long-standing solution. They're just watching how many ships are transporting through the Strait of Hormuz. Is there enough of a U.S. presence and potentially even allies participating in that to protect a certain critical mass of tankers getting through the Strait of Hormuz without getting attacked by Iran, even if there is no agreement?
I think that the most realistic outcome here is kind of what you see is what you get. I think the U.S. Navy is going to be involved in providing guidance through this southern route, with the Iranians periodically firing on ships to make a point and try to establish their control over the strait. This is something that could go on for quite some time. As you pointed out, there's a huge differences between these two governments. This may be the status quo. Let's look back to the 1980s and the tanker war. We lived with this for quite some time. So we may yet again be involved in a prolonged operation to ensure the free flow of energy resources out of the region. And it will mean a more consistent American investment in the region than the president even signaled not long after he signed the MOU.
Steve, this goes against the theory that we had a number of months ago, and it came out of the Treasury, and it certainly wasn't original, but it was called Operation Economic Fury, that you'd put so much pressure on the Iranian economy that ultimately they'd have to change their approach to negotiations. Any sign of a change of approach?
No, the president did revoke the license of the Iranians to sell oil, which will have an impact on the Iranian economy. But what has been striking about this entire episode is that the Iranians are neither willing to capitulate on the battlefield nor the negotiating table under very significant economic pressure. This demonstrates what analysts have been saying for a long time. The regime remains intact and willing to apply a lot of pain on the Iranian people to ensure its survival. So Operation Economic Fury has not yielded any greater results than Operation Epic Fury.
Is there a vulnerability, Stephen, that they need to look at? They've looked at economic pressure. It's not worked. Military pressure, overwhelmingly, the American military is superior in a number of ways. That's not worked either. What would work?
Well, what would work would be the Iranian people rising up and bringing down this regime itself. That's what the United States and Israel tried to do to create an environment in which that would happen. But that underestimated the capacity of the regime and its ideological cadres to hang on. We don't know what will happen 6, 8, 10, 12 months from now. There was a significant time lag between the operations against Iran in the summer of 2025 and major protests that shook the regime in December and January. But we have very, very little insight right now as to what is happening inside Iranian society. We know times are tough for the Iranian people, but there's been no sign so far that they are coming out into the streets and demanding an end to the regime.
Stephen, earlier in the conflict, there was some discussion around the U.S. running out of munitions, and that was part of the pressure to relieve maybe some of the most serious bombing efforts. Do we have a latest update on that? Do we have a sense of where that is?
Yeah, I've seen some data on this, and that we have run down by almost 2/3 some of these munitions that we had built up over the years. And that is likely one of the reasons why the president has said, we're going to hit them hard, and then says they're begging for negotiations, a signal that he remains committed to a diplomatic solution to this problem. The munitions issue is a big one, and it is a very significant discussion here in Washington about the evolution of warfare and how these exquisite weapons that take lots of time and lots of money to build may not be appropriate in the age of drones and AI.
Steve, it's good to see you. Stephen Cook there of the Council on Foreign Relations. To Steve's point, the asymmetric nature of a lot of this, that you can basically hijack an international waterway with some cheap drones.
You have to completely rethink how you deploy your munitions and what timescale. Being able to do it rapidly doesn't mean that that is the best policy.
The new normal. Don't know how you all feel about that. This could be the status quo for quite a while.
I think you know exactly how they feel about it.
I'm sure. They're not very happy about it.
Yeah, exactly.
Us, them, us,
yeah.
we, they. Earnings from Delta Airlines just seconds away. We'll get to that in just a moment. Equity futures on the S&P 500 unchanged. On the Nasdaq down by about 1/3%. On the Russell we're down by 1/10. The snoozy start to this Friday morning stateside. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Ahead of SK Hynix's debut later this morning, we are seeing some pressure across the memory trade with names like Micron and Western Digital feeling the pressure, but it has been a rough stretch, a choppy stretch for these names as investors rotate out of their biggest winners. And yes, these are the biggest winners in the market this year. So that makes SK Hynix's $26.5 billion U.S. listing a real test for investor appetite. It's already, SK Hynix is already one of Asia's biggest success stories. So now U.S. investors will get a chance to weigh in. Meanwhile, we are seeing Meta shares gaining, outperforming the Mag 7 this morning, up more than 2% in the pre-market after a report from the research firm Semi-Analysis argued the company has the best chance at catching up to OpenAI and Anthropic. It points to Meta's massive AI infrastructure build out and even projecting the company will have more AI compute than both rivals by year end. And we end on this company, CCC Intelligent Solutions. Shares are jumping 7.25% in the pre-market after Reuters reported that the insurance solutions company is exploring a sale. It comes after a difficult stretch, of course, for software companies as investors fear AI disrupting their business. And it has hit this stock especially hard with shares down 30% year to date. John?
Yahara, thank you. Thank you very much. We promised you an update on Delta Airlines. The earnings just dropping. Here's the stock price reaction. The latest from Delta reaffirming its full year profit guidance.
Yeah, for $6.50 to $7.50. The estimate had been $5.95. Interesting to see the shares up on this. And I'll tell you why. Even though it's an outperformance pretty much across the board, those shares are up more than 28% so far this year. The expectation was the bar is so high that for them to out-deliver, to outperform, they had to really deliver something amazing. They did beat when it comes to when it comes to just general earnings. Passenger sales, passenger revenue, however, came in just a little bit light. Where did the outperformance come from? It came from the American Express partnership, increasing 16%, and it came from business travel and premium travelers who saw their bills go up significantly, and they were a lot more active. So is Delta a story for the rest of the airlines and for the rest of the economy? Or is Delta a story of a K-shaped economy where the upper part of the K is doing well enough to offset really big fuel bills that didn't seem to really impede the full year forecast?
The execution is pretty impressive. We came into the year, let's just take oil. Oil came into the year in the 50s. It averaged the second quarter in the low 90s, around 93 on WTI. And this morning, they acknowledged that cost of fuel is still up 50%. So you've seen a massive spike higher in fuel. What does it mean for the broader economy? At Bastian saying this morning, I would not anticipate any decline in airfares. That's what the airline business is telling you, because the airline business is going through something very significant off the back of this spike in fuel.
And pretty much every executive in the airline industry, and they are uniform in saying this, will go out there and say that airline tickets have lagged behind inflation for so many years. They're just playing catch up. Prices are not going to go down, and a big key issue has been capacity just hasn't really expanded. So how much are we going to see consumers continue to absorb these higher prices versus pushback? Right now, the top line growth at Delta looks like people are continuing to travel, and business travelers in particular. Interested to see which areas, aerospace and defense, banking and automotive, were the biggest business travelers. So maybe some big deals in those areas.
Delta this morning up by 3%. Compare and contrast the words of Ed Bastian with the words of the PepsiCo CEO just yesterday. The consumer is worse than we had anticipated, and it's driven mainly by gas prices.
two different consumers, and that I think is what we're seeing. And how much do you continue to see that bifurcation throughout different consumer-facing companies? Interesting to see who's going to succeed, who's going to fail, and can we draw larger kind of conclusions, or is this going to be a company and part of the consumer story specific issue?
Bramo on tour Monday morning. Don't miss it. 8:45 Eastern Time. Lisa catching up with Ed Bastian, the Delta Airlines CEO, next week.
Yeah, I'm curious to see what he thinks for the forward outlook. They are maintaining their forward guidance, but do they start seeing some pushback from the lower income consumer? Does a lower income consumer fly Delta? That's another question. And how much they see the other aspects of their business increasingly financing what they do when it comes to the bread and butter of actually flying, right? Is it a credit card company or is it actually an airline industry?
Credit cards with wings, isn't that what you often say?
You know, if it's a beautiful credit card with lots of beautiful seats. And I'm also curious about what we were talking about yesterday, the sort of basic business and how much lower that's going to be, because I think a lot of people would actually be into flying flag.
I'd get seat anxiety. I need to know what seat I'm sat in and where I'm going to be on the plane.
You have seat anxiety.
Seat anxiety.
So
yeah.
how much are you willing to pay for seat anxiety?
Well, I want to see how big the spread is between the basic price and whether work forces that on us or not.
Okay, this is good. Yeah, then you could sort of weigh your seat anxiety.
I get one of those dogs to go on the plane with me.
You can peacock.
Get one of those dogs or a peacock or whatever the animal is, so I can get through that seat anxiety of finding out what my seat is on the plane.
Yeah, your comfort peacock. You can borrow mine.
Is that what you've got?
Big time.
I remember when Matt Miller took a Rottweiler on as his comfort pet. Yeah.
And I believe that another member of his family was in the back of the cabin.
I'll tell that story another time. Delta Airlines this morning up by about 3 to 4%. On our radar this morning, the top story: SK Hynix ADR set to begin trading on the Nasdaq today. The company raising over $26 billion, making it the largest ever listing by a foreign company in the US. Elsewhere, Fed Chair Kevin Warsh naming the leaders of the 5 new task forces created to advise the central bank. The leaders include 3 former central bankers, university professors and corporate executives. And finally, Japan's finance minister making a bid to strengthen the country's currency, calling on the nation's pension funds to boost their investments in domestic assets as the yen sits near multi-decade lows. And that right there are some of our top stories this morning. Let's turn back to our other top story then. On Wall Street, investors are awaiting the blockbuster US debut of SK Hynix. Jing of Morningstar writing, I do not think the listing itself will largely impact the sector view as a whole fundamentally. We could possibly see some shift in fund flow in the near term. Jing joins us now for more. Jing, welcome to the programme. I just want to build up on that last line. I think it's important. People talking lots about that trade, that maybe you short the local listing and get long the listing here in the US. How do you see flows emerging off the back of this listing?
Yeah, well, I think, the most important thing here, I think we can all agree upon is that, this listing there's massive appetite for the listing, right? I think what investors are looking out for, most importantly right now, is the fungibility of shares. Should shares be fungible, should there be any restrictions on fungibility in shares, we could very well see shares trade at a persistent premium over what they are, over what they're currently trading at now, in terms of Korean shares, and we could possibly see greater demand over there.
Do you see others following suit, given what we've seen and how this has played out and how welcome this listing has been, the amount of demand? Jing, do you see other names following?
Yeah, well, that's definitely a possibility. Right now, I don't think, there hasn't been any concrete announcement. But I think as a whole, memory players in Korea do trade at a discount towards their US peers. Part of the goal of this listing is to actually close that gap between the Korean memory makers as well as the US memory makers as well.
There's also been a number of leveraged ETFs and other funds that have launched in tandem with SK Hynix's IPO in the United States to gain access to this in more extreme fashion. Does that concern you from either a creditworthiness or just stock performance basis?
Yeah, well, I mean, I think those listings really play to how strong the AI trade has been over these past 6 months, and is also deriving from great investor interest. I think beyond just the leveraged ETFs themselves, we also look at even stocks themselves, right? Margins on these stocks are at record highs, right? Retail participation on these stocks are also at record highs. So there is a lot of interest in these stocks, and and it has resulted in quite a bit of volatility. So we would put more caution towards the stocks as a whole from a risk to reward perspective.
What do you make of the fact that we have seen a bout of volatility that's been pretty extreme in terms of the Kospi and just some of these names specifically over in Asia at the same time that SK Hynix is able to raise $26.5 billion in the United States with an oversubscribed offering? I mean, how do you explain this dissonance of both an understanding of incredible volatility, leverage, but also really substantial demand?
Yeah, well, I think when we think about the ADR listing, I think it's a mix of strong demand for AI names as well as access, right? Greater access towards Korean tech stocks as a whole. The volatility over the past few months is really reminiscent of how high expectations are in terms of where memory prices can go, in terms of where profits can go for these companies, and perhaps how sustainable these profits are over the long term. And this back and forth between investors as a whole has really resulted in the tremendous movements in the stock. I think more importantly, when we see these profits and we see these profits going up for these stocks, throughout the first 6 months of the year, it really points towards a very positive near-term picture. But I think investors are still debating on the longer, longer term views on whether memory is still a structural pricing story or a cyclical pricing story. And we still don't see a very clear answer on this. And I guess that's where a lot of the volatility lies right now.
Jing, best guess. What do you think it is? One or the other as you think about the long-term debate?
Yeah, so here at Morningstar, my base case view is that we should see strong prices well into 2027. There's no supply coming up in the near term, and demand remains robust. However, we are a little bit more concerned with the long term. I do expect cyclicality to return towards the end of the decade, as strong supply comes up in the second half of 2027 onwards. And to us, the AI monetization path here still remains relatively unclear. And we think that the probability of that, positive view coalescing is still not very high right now.
Jing, it's good to see you. Thank you. Jing Ji Yu there of Morningstar weighing in on SK Hynix following a record equity raise for a foreign company, first-time equity raise here in America from SK Hynix.
And it came despite the volatility that we've seen. It came despite some of the warnings that we've heard that maybe some of the memory chip names have gotten overpriced, that perhaps people are pricing in over-optimism in terms of how long you can get these 85% profit margins. Nonetheless, they still saw substantial demand. You asked a great question. Does this open the door to others? Is this saying green light, you don't even have to offer a discount? Because normally you have to offer a discount to where the shares are trading in their home indexes, their home exchanges. This actually was at a 3% premium. So again, it really sort of breaks some molds and gives a real green light to others.
I have a very simple question. Maybe it's easy to answer, but if these guys believe it's a good time to sell, why is it a good time to buy? And that's a question that I would have for a lot of companies issuing equity and debt right now. The supply has really picked up. It's a massive change from what we've seen over the last decade. I know I keep beating the same drum, but I think that's the ultimate question. They've made the decision that now is the moment to issue equity, to issue debt. I get the reason why. Demand is fantastic, but don't you have to question whether this is the peak of the cycle?
Especially if they don't have any need for that cash, because right now the amount of cash flow that the likes of SK Hynix are throwing off is absolutely substantial to supersede any kind of spending plan that they have.
Nasdaq futures this morning down by just a third of 1%, unchanged on the S&P 500. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Shares of Delta rising in the pre-market. The airline posting second quarter earnings that beat on the top and bottom lines. Delta also reaffirming its full-year outlook. And tune into Surveillance Monday at 8:45 a.m. Eastern for Lisa's interview with Delta CEO Ed Bastian. Taiwan suspends stock trading and shuts schools and offices in preparation for a typhoon. The storm is expected to dump heavy rain over a vast area and could lead to extensive flooding through Sunday. France is one step closer to a World Cup title, securing a semi-final spot with a 2-0 win over Morocco. The French now take on either Spain or Belgium, who will face off in the second quarterfinal tomorrow. And that is your Bloomberg Brief. John.
Bonnie, thank you. Did you watch this one yesterday?
I didn't watch it, to be fair.
Kylian Mbappe.
Oh, yeah.
Seriously, the window for that goal, for that shot, was like this big, literally, and executed it perfectly.
There are a couple of stars of this particular World Cup. Mbappe is one, Messi is the big one, and then, of course, Haaland, the Viking from Norway, absolutely rocking the social media airwaves.
They are lighting up this World Cup. Haaland versus Kane coming up tomorrow. Up next on the programme, reforming the Federal Reserve.
I'm appointing a task force in each of 5 areas. That'll be taken up by the task force. We've got a task force for that. I've been on a task force or 2 in my life. It's one of the things we have a task force to do.
I don't mind the list, you know. I think it's a really good list of names. I think it's inspired.
I completely agree. I was really impressed by it.
Doug McMillan on data.
Yeah.
That's pretty cool.
Yeah.
Andreessen on productivity. That makes a lot of sense too.
And job changes. And you have, Merlin King. I mean, you've got a lot of people who have been in the industry a long time who have great perspective.
We'll talk to Kit Juckes of SocGen about that in just a moment. Live from New York City, you're watching Bloomberg TV. It's a quiet start stateside in equity markets. Equity futures going nowhere on the S&P 500. On the Nasdaq 100 this morning, down by about 1/3%. In the bond market, 2s and 10s yields bleeding higher on the week, up by single digits, up by a couple of basis points. Down this morning, we're down 1 to 416.82. On 2s, on 10s, still around 450. Heading into next week, next Tuesday is just massive. We'll spend some time on that later in the programme. But next Tuesday, we get 5 banks reporting earnings, get CPI in the morning, and a few hours later, the Fed chair speaks. That's quite a day coming up a week away.
Yeah, a key question for people is just how much you do see this inflationary pressure stemming from AI and from other non-oil related metrics. Really edified by what we heard from New York Fed President John Williams yesterday, where he really leaned on the AI component. We'll get that with CPI, and potentially we'll hear that in some of the CapEx plans from some of the biggest banks.
Let's talk about the outlook for the Federal Reserve under surveillance this morning, reforming the Fed.
I'm appointing a task force in each of 5 areas. You'll hear quite a bit more about these task forces. That'll be taken up by the task force. We've got a task force for that. The good news for you is we have a task force for that. We have a task force on that too. I've been on a task force or 2 in my life. It's one of the things we have a task force to do.
So the good news is we've got some details on those task forces. The Federal Reserve Chair Kevin Walsh announcing the leadership for its 5 task forces created to review key aspects of the central bank's policymaking. The list including venture capitalist Mark Andreessen and the former Walmart CEO Doug McMillan. Joining us now to discuss is Kit Juckes of SocGen. Kit, various central banks have been through this. More recently, I believe the Bank of England did a number of years ago. What do you expect to be the outcome of these particular task forces?
I'm actually genuinely excited to see the outcome, just because we've come through, since the early 2000s, so many problems for central banks, through from, the bubble bursting at the beginning of the century, then 2008, then the Dubai crisis and the European sovereign crisis, and then on to COVID. And here we are with people asking questions about what the Fed's doing and some of the things that they've been trying to do, and they need to get credibility back internally and globally. Central banks do. They need to get on top of it. And if we're going to go and look and say a bunch of task force on how they communicate, how they run policy, what the limits are to policy, more concretely around what is the plan to exit quantitative easing or vast balance sheets, if they can get their arms around some of that to get some of their credibility back in the right place, then we can move back to a world where we're confident that central banks are going to be independent, or that the most important one can get back to being properly independent, and the whole world's a better place if we can get there.
There's an argument that we should address, get credibility back. Why do you believe they lost it in the first place, Kit?
I think partly they lost it because through the 1990s, being central bank governor was quite easy in the sense that we had all these tailwinds behind controlling inflation. So the growth inflation combination wasn't bad for lots of people. So they wandered around being superheroes. And since then, it's got harder. So, they've strayed outside their remit into looking after other things than controlling inflation, and in the US case, keeping growth on trend or a sensible level. And have kind of got away from what they should be doing, lost control of their balance sheet, done things that were perhaps, they said would be temporary and haven't been, didn't sort out QE before we got the next round with COVID, and just sort of left themselves open to criticism from all sorts of corners. And now, frankly, the US has too much inflation, and everybody can see it, and they need to get their arms around what they want to do about it.
It was striking to me how many people are on these task forces that are not from the United States. They're from global central banks and generally just outside of the central banking universe. Doug McMillon, John was mentioning, the former CEO and president of Walmart. What do you make of that? That the central banker from Brazil, the former central banker from India, Mervyn King, the former central banker from Bank of England. How much are we looking at sort of a tone that's going to be set for central banks around the world?
I hope so. I mean, it's in a sense, it's only surprising when the US does it and includes people from everywhere, because the US has so many people at home who are good at things. But I think it's a very good thing. And let's not make the mistake of thinking the US is the only central bank that needs to sort out where it stands in the kind of in the next phase of the global economy and get in the right place for some of the challenges we're going to get, from AI, from investments in AI first and then from AI afterwards. And some of those things we get from a world with more protectionism now, very clearly. I think the more global it's seen and the more it becomes something that's sort of kind of a new blueprint for where central banks might go, the better it would be. But we'll kind of have to see where it gets to for that.
Earlier this year, there was some speculation that some investors were finding the dollar less desirable because of concerns around central bank independence, that on the margin, this was shifting people away from the United States. Do you think that some of the shifts that we're seeing from the Federal Reserve could reverse that? Do you expect that to sort of have any market ramifications over the short term?
I haven't seen much evidence that any of it was happening from the data so far, in the sense that foreign appetite for US assets has been very strong, largely because they've had better yields and better growth, depending on whether they're bonds or equities. But yes, lots of people talked about it. I think this is the kind of measure that can, if done right, and we'll have to see how it works out, completely put that to bed and restore confidence in the dollar's position in the world.
Kit, do you think, and this is the ultimate question, that this central bank can hike interest rates before these task forces wrap up their work?
Yes, they can, because if they have to, they will, in the sense that I think for now the plan is to do nothing with policy, stay on hold. But if they start looking like they're losing control of inflation over the course of the next year or so, I think the pressure will just grow and grow. I think that's what we learned from the minutes of the last FOMC meeting.
What does losing control look like, Kit?
It means looking as if we're going to go higher inflation or stay here on inflation and not ease back with oil prices lower.
Kit Juckes of SocGen. Kit, thank you, sir. Appreciate it. Above target for 5 years, the pressure on this institution. I think a lot of this is inspired. I like that on communications, they've gone to the former central bank president of Brazil. I like that because I think that DM central banks are facing EM dilemmas continuously, particularly over the last several years. We've both said we like that Mark Andreessen is looking at productivity and jobs because tech will have so much influence over that in the years to come. And also, is there anyone out there that knows more about pricing in America and inflation than Doug McMillon, the former president and CEO of Walmart?
And the data, because ultimately they've got such an incredible footprint to really see real-time consumer activity. How much is this Federal Reserve in a new iteration post-task forces going to be using private market data in an increasing fashion to give them some sort of real indicator of exactly how the consumer is doing? A lot of people looking to this. I think what Kit Juckes was talking about there is really important, which is it kind of sets a tone for the rest of the world when you have global central bankers sitting on the seats in these task forces. This isn't just a Federal Reserve that's reassessing its function. It is clearly setting a tone for the world. And that, I think, is really interesting. And you saw that over in Sintra when suddenly everyone was getting on the train that forward guidance was useless. So is this a shift in just market cycle, or is this a shift in central banking policy that can get instated around the world?
Earlier on this morning, I said if you want to make a fool of someone, ask them for a crude forecast, right?
Yeah.
If you want to make a fool of a central banker, ask for a forecast. And that's kind of where they are right now, scarred and burnt by making some forecasts that turned out to be terribly wrong.
Yeah, the dot controversy and whether the dots will get thrown out and what exactly will be their tool of signaling. I think the key is just reaction function, and that, I think, is what a lot of people are struggling with right now.
Coming up next, we'll catch up with Lisa Shalett of Morgan Stanley, Ed Mills of Raymond James, Stephen Trent of SDT Capital Advisors, and Ed Al-Hussainy of Columbia Threadneedle. The second hour of Bloomberg Surveillance is just around the corner.
ultimately, the economy is doing fine enough right now.
The Fed can shift pretty quickly as events shift.
They have to get credibility back, and I think focusing on inflation is a way to do that.
We're going to need to see a few hot inflation prints before they do anything.
I think we will have a period of some pretty strange inflation data over the summer.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. The scores look like this. Equity futures on the S&P 500 just about positive this morning. We're down by 0.25% on the Nasdaq. The headline from South Korea's SK Hynix raising more than $26 billion, a record first-time equity issue from a foreign company here in the United States of America. Elsewhere, the earnings are starting. Delta Airlines reaffirming full-year profit guidance. The stock is up in the pre-market by 0.8%. This guidance first offered at the very, very start of the year. The fact that guidance has stuck, even with everything that's happened with costs, is pretty impressive.
The fact that they had the biggest fuel cost in their history and they could still overcome that, supersede those extra expenses with an increase in revenues and maintain their full year guidance is setting people into the shares. Even after a more than 28% gain so far this year, Delta has been the leader when it comes to the major airlines in terms of performance. Key question will be how much is Delta setting the tone for the rest of the airline sector, for the rest of consumer-facing retailers in the United States, and how much is this a story of the K-shaped economy? And it sounds so cliche that I'm almost cringing at myself, but still, people who have money at the upper income levels can spend and are getting more money, and people at the lower income are getting stressed.
I've said it before, it's the Delta Airlines economy, right? Half the country thinks it's Group 1, and the other half is really struggling and can't even afford the back of the cabin, particularly at Delta Airlines.
So who is the person who can afford business, the lie flat bed, but is the basic business, and is it going to be stripped out when it comes to all of the extra bells and whistles? Like, that's, I think, going to be an interesting question. How is the American consumer getting parsed out all of these levels? But still, there is a corporation that is spending a lot of money, and that is in the aerospace industry, that is in the automotive industry, that is in the finance industry. That also helped support Delta. And again, setting the tone for why the economy has continued to do well, even as people really don't feel good on average.
It's a message for the Federal Reserve from Ed Bastian this morning. Delta Airlines CEO, I would not anticipate any decline in airfares.
A lot of people have been talking about how these prices are going to stick. The airline industry in particular has talked about how airline prices have not caught up with the inflation overall. They've lagged behind, so they're not going to come back down. That said, it's not just oil prices. Cost inputs are rising all over. We heard this from John Williams, tied to AI, tied to new investment, tied to new technology more broadly. And clearly, you're seeing that in the price.
Stock is up by almost 30% year to date. It's up by almost 1 percentage point so far this morning. Coming up on Monday, 8:45 Eastern Time. Don't miss it. Bramo catching up with the Delta Airlines CEO, Ed Bastian, Monday morning at 8:45. Looking forward to that. Coming up this hour, we'll catch up with Lisa Shalett of Morgan Stanley, warning chips may be overbought ahead of SK Hynix's US debut. Stephen Trent of STT Capital Advisors breaking down the latest earnings from Delta. Plus, we'll catch up with Ed Al-Hussainy of Columbia Threadneedle, with Fed Chair Kevin Warsh announcing his task force leaders. We begin this hour with stocks flat as Wall Street braces for SK Hynix's record-setting US listing. Lisa Shalett of Morgan Stanley writing, we advise revisiting the Mag 7 for potential opportunities, especially in light of our view that semiconductors are meaningfully overbought. By comparison, we believe hyperscalers look downright cheap. Lisa joins us now for more. Lisa, let's start with one before we get to the other. Chips, meaningfully overbought. What gives you that idea right now, Lisa?
Oh, my goodness. I mean, all anyone needs to do is look at some of these charts that have gone completely hyperbolic. Whether you're talking about, the Philly Sox over the last 8 to 10 weeks, we're literally at certain points, we're up literally 100% on the year. We've obviously had some churn and some pullback recently. But, whether you're looking at the participation in the Philly Sox, you're looking at semiconductor ETFs, you're looking at levered ETFs, it's all part of this same trade. And so much of it is related not just to swollen order books in across the industry, but quite frankly, folks extrapolating the sustainability of pricing. and the pricing power, obviously, that companies like Micron have been able to embed in their earnings and their huge earnings surprises.
Lisa, so many people are waiting before they get out to see a reduction in capex. They're waiting to go to the hyperscalers once they see a reduction in capex. You noted that early this week. Why not wait until that?
Because I think that we're in the early innings of the beginning of that deceleration in the capex process now. Like everything, what we tell people is you can't market time these things to the day. You have to kind of sense changes in the second derivative, and we're sensing it. I mean, just look at some of the news flow that you're seeing from companies like Meta. It kind of signals to you that there are conversations about the rate and speed and return on investment on some of this CapEx and how can they pull forward their monetization strategies.
Lisa, yesterday we talked a lot about Meta now creating their own chip, Meta trying to be much more like a hyperscaler. Do you think that some of the reduction in capex that you're feeling out not only is coming from the likes of Meta saying maybe we'll sell some of our compute capacity, that's a better proposition than using it internally, but also because of pushback that you're seeing in financing markets, particularly in fixed income?
I'm not sure that the way these guys are behaving has to do with access to capital, just quite bluntly. I mean, I think that there's ample capital still available broadly to this trade and to most of the companies in it. I think this is much more about engineering and economics. Whenever you have a scenario where supply chains get bottlenecked and folks are extracting excess rents, as some of the memory chip guys are, the engineers get to work. And that's what we're seeing. And we're seeing the AI data center tech stack, if you will, being re-engineered to include lower cost proprietary chips that many of the hyperscalers are now designing themselves and having manufactured white label. They are using a combination of open source as well as frontier lab models, all in the effort to compete on price and essentially to consume less energy per token.
Do you see us entering a phase where AI is less inflationary as a result, where there is more discretion when it comes to how much hyperscalers in particular are willing to pay for chips, for other particular inputs, that actually could reduce how much it's really adding to the U.S. inflationary backdrop?
Absolutely. I mean, I think the front end of this story is NVIDIA, to be honest. I mean, you roll back the clock a year, almost every hyperscaler felt that they had no choice but to, buy NVIDIA GPUs exclusively and continue to queue up for the latest and greatest addition. I think now, those GPUs are actually net losing total market share of data center AI designs, and some of these proprietary ASICs are taking share. And so I think what we've seen with NVIDIA, and the stock has kind of stalled out over the past 6 to 9 months as a result, we're going to start to see with some of the other semis.
So, Lisa, we're talking about 20% of the index, that's semis on the S&P 500 right now.
Crazy.
For some people, 100% of the sentiment, the enthusiasm for this market. Where does it leave the index outlook, Lisa, if you believe that big chunk of this market is overbought?
Yeah, so what we have to remember is that the market is also concentrated on the other end, right? It's concentrated in some of the hyperscalers that have sold off. And so what's happened is that, as we've had this churn, right, we've had this huge move and the change in market capitalization of the semiconductor industry from about 3% of the index to 18%, as you point out, and the hyperscalers have actually lost share of the index, and we've quote unquote deconcentrated, and that's kept the overall index in a zip code. I think if this intra-tech trade continues to churn, right, we can absorb, a 10, 20% decline in semiconductors as we already have in the last couple of weeks. and not have a lot of damage to the headline index. That's one of the good things, if you will, of having the hyperscalers be as big as they are as a group.
Lisa, it's good to see you. Enjoyed the note earlier this week. Thanks for joining us this morning. Thank you. Lisa Shalett there
Have a great
of Morgan
weekend.
Stanley. You as well. The message pretty clear here. Don't wait for a reduction in capex to get out. That's the message I took away from Lisa's work this week.
Yeah, and that some of what we've heard from Meta in terms of selling compute as well as developing their own chips is sending a really loud signal. Also, the idea that you're seeing headcount reductions at places like Microsoft, they say it's not necessarily tied directly to AI investments. Nonetheless, clearly shifts going on to rationalize some of the spending, which is a clear departure from where we were, say, a year ago.
My spidey sense was up too with regards to Meta. My takeaway from our interview that we had here at Bloomberg in the last 24 hours was just a lack of conviction. And I found that unusual for someone like Zuckerberg, who usually is pretty sort of full force thinking about the future and with tons of conviction and confidence. And I didn't sense that at all about where that spend was going and what it would be used for.
Which maybe is a reason why they're selling some of it. Also, after a couple of flops. Remember, they changed the name to Meta because the metaverse is going to become the next best thing. And needless to say, it hasn't. And now question, how do they really justify some of their expenses? Is it going to be becoming very much like some of their competitors with respect to hyperscaler-esque types of characteristics?
A bit of confusion around that name at the moment, that's for sure. Equity futures right now, the S&P 500 just about unchanged, turning positive just moments ago. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Volkswagen is cutting its model lineup by as much as half as part of a savings push. The New York Times reporting the German automaker is dealing with falling sales and increased competition from Chinese automakers. Shares of EasyJet rising in London trading. The budget carrier receiving a fresh takeover offer of $7.7 billion from private equity firm Apollo Global Management. That beats out a rival proposal from Castle Lake. Goldman Sachs tightening its personal trading rules, restricting employees from betting on a range of prediction market contracts. According to a document seen by Bloomberg, the policy prohibits trading on companies, election outcomes, or the performance of any financial market. And that is your Bloomberg brief. John.
Vonnie, thank you. The good news for the degenerates, as they call them, the betting, the gambling bros, over at Goldman, if you're over there, is you can still bet on sports and entertainment, apparently, based on this memo that we've seen here at Bloomberg. But repeated violations of the policy might lead to a firing or closing of a member's account. In cases of improper trades, the bank can also require staff to forfeit profit over $200 or donate it to charity.
I want to understand the backstory to this because I am assuming that something transpired to come up with these very specific prescriptions. And honestly, I'm not that surprised. I mean, it is a huge liability, especially at times where people are saying that prediction markets are increasingly rife with insider trading and people who have other knowledge. I mean, why would you expose yourself to that liability?
Some of the bets that I've seen, away from prediction markets, but some of the bets, just the sports gambling of the last week, like people who had bet $100,000 on Haaland not scoring at a game.
Yeah.
Can you imagine the experience of that game? I sit at home, I enjoy the football. Having that much money online, hoping that a certain thing doesn't happen that some people might not even think about?
Some people are created differently. Some people, like people sitting at this desk, might have anxiety that would create such a terrible viewing experience that it would not be worth any money in the world.
I've got a buddy who had several bets on about a score or assist, and there were 4 or 5 different players involved in this in the last week or so. And they were just watching the French game, waiting for Elise to either score or assist to complete this bet and get the payout.
You know, I don't know. I can't relate.
Not how
No, and I wonder how it's going to change the sport, and also raising questions about some of the referees and some of the calls.
Yes.
And that also leads to other potential issues, but I digress.
Yes, I won't go there. Equity futures right now, the S&P just about unchanged. Up next on the programme, the cost of war hitting home.
I don't care about the midterms. People understand it. They know that, very simple, Iran cannot have a nuclear weapon. I'm doing that for the world. I'm not doing it just for us.
Up next, Ed Mills of Raymond James. So let's go cross-asset equities this morning, just about unchanged on the S&P, down on the Nasdaq by 2/10. That's the equity market picture. Here's the bond market story. 2s, 10s and 30s heading into next week with CPI and Fed Chair Kevin Walsh's testimony on deck. Two-year yields near the upper end of the recent range, close to 420, 416.82, yields down a single basis point. Check out the move in crude. WTI and Brent facing down a couple of things this morning. We're up by 0.4%. Some record supply coming out of the UAE. That's notable. And this headline is too from the New York Times. Qatar in talks with the US and Iran to de-escalate. Really matching our reporting here at Bloomberg to some extent, reinforcing it, that the talks are ongoing between the two sides.
Yeah, and this has been a real question about what kind of ability there is for two sides to continue negotiations when there is no trust. We did have reporting saying that there were technical talks ongoing. Again, the goal here, just reducing the frictions to allow tankers to go through and potentially create some more calm in the region.
Under surveillance this morning, the cost of war hitting home.
They're going to outweight me, we'll outweight him, but I don't care about the midterms. People understand it. They know that, very simple, Iran cannot have a nuclear weapon. I'm doing that for the world. I'm not doing it just for us.
So here's the latest this morning. The war in Iran weighing on Americans ahead of the midterms. 58% of voters saying the war is not worth the cost. That coming from an FT poll. Bloomberg's Tyler Kendall joins us from Washington for more. Hey, Tyler.
Hey, John. Well, this represents a significant roadblock for Republicans as we head into November, and the diplomatic efforts to resolve the conflict in Iran feel like they are effectively stalled. Now, we've heard from President Trump try to find ways to retake the narrative when it comes to some of the economic fallout related to the war, including in the last week renewing threats to investigate big oil companies, and just yesterday announcing that a series of privately owned gas stations would be dropping their prices. But as the war continues to drag on, it's only compounding the domestic risks here at home, as this FT poll goes on to find that just 36% of voters approve of the job that President Trump is currently doing, down 2 percentage points from the previous month. Now, for context here, Democrats only need a net gain of 3 seats to retake the House and 4 seats to retake the Senate, though that may be a bigger uphill battle, because while Republicans are battling these issues, playing defense basically on the economic component that's been compounded by the war, Democrats haven't necessarily seized the moment. John, we have a new story out on the Bloomberg terminal that examines how party infighting, like what we're seeing play out in real time when it comes to Maine, is just slowing down Democrats' efforts to retake the chamber.
Tyler Kendall with the latest. Here's the latest from Ed Mills of Raymond James, writing the midterm elections loom large, limiting what can be reasonably achieved in the coming months. Ed joins us now for more. Ed, welcome. Let's just build on that particular quote. Is there evidence right now that the midterms have shaped the president's approach to this issue?
I think so. I think that there has been a lot of discussions with clients at Raymond James that before the midterm, he has to find an off-ramp, that part of the reason why we are in a ceasefire and why he continues to insist that the ceasefire is ongoing, even when there's kinetic activity, is a look towards the midterms. A desire to reopen the strait, a desire to cut these deals, to get as much gas and oil flowing to lower the price at the pump. He is the one that made it such an issue to say, I brought down the price at the pump. For it to have doubled for a lot of Americans since the beginning, he has to change that if Republicans have a fighting chance come November, John.
Do you get the sense that where prices are currently is good enough, that essentially this is the status quo that is acceptable to this administration to maintain going into the midterms?
I think that they need it to come down, and I think it's going to be about the rate of change, about the absolute dollar cost. It is a very strange thing that this is probably the one thing that most Americans look at and just kind of see it roll up as they're filling up their tank. There's no other metric out there that gets this much attention by the average consumer. I think if the election were held today, Democrats would win a majority in the House, and it is buoyed by some of this conversation we're having. I do think Republicans maintain control in the Senate. It would have to get worse from here for Republicans for the real shot for Democrats to have that majority in the Senate.
Do you get the sense that there's any focus in Washington about what's going on with Russia not exporting refined products, affecting diesel prices pretty much across the world, more particularly in Europe, but also on the margins here in the United States? I mean, that's one of the biggest inputs, direct inputs into product prices in the United States. How much do you see any kind of effort dealing with another conflict that's been ongoing for quite a while to ameliorate some of those prices?
Yeah, Lisa, I look to kind of a lot of the conversations that are going on here in D.C., and that comes up, but it's not a top issue. what I'd be looking at is that Trump is supposed to host Xi in September. There is some pressure that China could put on Russia. There are other levers that Trump is trying to pull, but that might be his best one. There's not a lot more he can do there without escalating that as well. So, yeah, it's on the conversation agenda, but it's not kind of a top issue. There is a recognition that it's a problem, but what to do about it? Not very many good choices.
Ed, I just wanted your take on the recent New York Times reporting. It came out just moments ago, suggesting that Qatar has been in talks with Washington and Tehran to de-escalate the crisis. The headline of this piece reads, mediators are trying to pull the US and Iran back from the brink. How close are we to the brink? Do you think, given what you just said about the influence of the midterms, is this a president really willing to renew this war, restart things again?
Yeah, so Jonathan, what we've told a lot of our clients at Raymond James is that expect to muddle along through this midterm election, that we're going to go through this cycle where we're going to have some kinetic activity, we're going to have a phone call, we're going to have a resumption of talks. It's usually one of our allies in the region that is trying to put these together. And then we get into the ceasefire, then we have talks, those break down, and we repeat that cycle. To me, the big question is, after we get through this midterms, one of the things I'm hearing more and more from clients is a concern that that's actually when things ramp up, that Donald Trump is going to say, I tried for 6 months, they wouldn't negotiate, we have to go hard. After the midterms, he is never going to be on the ballot again. So does he have the kind of limits come off and things escalate? And that, for me, is the big market debate, and whether or not that is going to be the issue we have to deal with in November in the immediate aftermath of the election.
How would you come down on that current debate? What would inform your particular forecast on that issue?
My view is that when Donald Trump has put together military kind of force, he uses it. I don't think that there is a opportunity to kind of have the bid-ask spread condense here between the United States and Iran. I think it's going to take some more time. And I do think that, unfortunately, he probably has to escalate for there to get a final agreement. My hope is that it's not long, but I would put myself in the camp as more likely than not after the midterms. This is where it truly does flare up, John.
As we do head into the midterms, I do just want to get your take quickly on what you make of President Trump firing Democrats on the Election Commission and the resignation of a Republican member. How significant is this?
Well, I think it's, Lisa, one of the things that we looked at is the recent Supreme Court decision on the FTC, the Slaughter decision, gives him enormous powers to fire folks at will. One of the big questions we get at Raymond James is how long, if a Democrat were to win in 2028, how long would it take for the pendulum to swing back for kind of a much more aggressive regulatory agenda? And the answer is it has gotten significantly prolonged because of that Supreme Court decision. So this election firing is the latest example of his ability to fire folks at will. And I know it's a while away, but if we go into the 2028 election and a Democrat wins the presidency, but Republicans have the Senate, there's going to be so many boards and commissions and functions in the United States government where the Democratic president's going to have a choice. They're either going to let the Trump individual continue to run that or have no commission at all. That's going to be the FTC, the FCC, the SEC. You go down all that alphabet list. So the big question here to me is how long does that Trump deregulatory agenda continue? And because of the Supreme Court, it's a lot longer than most investors really appreciate.
Ed, it's good to see you. Always is. Thank you, buddy. Ed Mills there, Raymond James. Thank you very much. 2028, the general. That's going to be the focus in a few months' time, very quickly. Primaries and the general just around the corner.
It used to be that who was president mattered less because the muddle in Washington was that much louder. Increasingly, the presidency has quite a bit of power, so that it's going to be an incredibly important election.
Coming up next on the programme, Stephen Trent of STD Capital Advisors breaking down the latest earnings from Delta, plus Yahira has your morning movers Meta higher following a positive report on its compute business. Stocks unchanged on the S&P, going nowhere this morning. We're down about 0.25% on the Nasdaq 100 as we count you down to the opening bell, a few hours away from the cash open. On our radar this morning, Delta rising in the pre-market after exceeding earnings expectations for the second quarter and reaffirming its outlook for the full year. Lisa's going to catch up with the Delta CEO Ed Bastian this coming Monday at 8:45 Eastern Time. Shares elsewhere of EasyJet getting a boost in London trading after receiving a $7.7 billion takeover bid from Apollo, the proposal surpassing rival Castlelake, opening the door to a potential bidding war. And finally, SK Hynix raising more than $26 billion ahead of its trading debut on the Nasdaq, making it the largest first-time share sale by a foreign company in the US and the third biggest listing in history. Just absolutely amazing.
Yeah, and it comes, Lisa Shalett really setting the tone, saying that the pendulum is swinging away from semiconductors back to the hyperscalers. It seems like a lot of people are getting a bit queasy by how high valuations have gotten and how much people have just plunged into these names with leverage when it comes to retail trading. I just wonder at what point you start to see this crack in a more fundamental way. If there is an effort to lower costs, which we're seeing increasingly, how much does that start to filter into expectations for semiconductors versus the offset multi-year contracts at very high levels because of memory constraints that continue to be ongoing?
So we've had the biggest foreign debut in the US, we've had the biggest IPO we've ever seen, and we had an $85 billion equity capital raise from Alphabet, all of that in the last 2 months. And we might still get Anthropic and OpenAI in the next 12. It's kind of wild, isn't it? More still to come.
You raised a point earlier that I think is worth sitting on, that what does it tell you if every company wants to raise money right now, even if they don't need it? Some of them really do need it, but what if they don't, which is sort of SK Hynix's issue? And it gives you a sense that they're sort of seeing, I don't know about a top in the market, but definitely conditions are favorable for them. That is the polite way of saying it. Does it mean that it's going to turn south? Does it mean that we're going to trade sideways for a prolonged period of time? Unclear. What it has meant is incredible volatility in single names. And that, I think, is really notable because even though the overall index implied volatility has remained fairly low, single name volatility has surged to the highest on record relative to the index and gives you a sense of how difficult it is for anyone to be able to game out specific stocks. And I still keep thinking that's a good tell of how the story is shifting, but it's shifting under the hood.
To some extent, it is a judgment on current valuations. Let's just put it that way, that so many people want to issue equity right now and issue debt. I know what they want to use it for. I've got all of that. But ultimately, if they want to sell now, you've got to ask yourself if it's a good time to buy.
Yeah, is it a peak enthusiasm? At the same time, cycles are born of these, and cycles can continue a lot longer than the shorts can remain bearish, as I'm reminded again and again and again. And, you know, ultimately...
I thought you got bullish now.
No? I just...
On the fence. Bullish in technology was the last time you phrased things for us.
I think that I don't make market calls. I will say that to be very skeptical of some of the advancements, if you've played around with any of these tools, is to be naive. This is going to be a world that's shifting, but I am not sure exactly how it's going to play out. I don't make calls.
I get it. I don't have an opinion on anything.
Oh, okay. All right. So you're trying to say that, like, I'm making a call. I'm just not making a call.
I don't have an opinion.
That is the biggest load of exciting information I've ever heard in my life.
Let's turn back to Delta.
Please.
I don't have an opinion on airlines either.
Anything.
The first US airline reporting results following a full quarter of capacity reductions and price spikes due to the war in Iran. I can have a view on food and football, can I? I think so.
Vacation.
Ed Bastian, the CEO, saying this: we delivered $1.4 billion in pre-tax profit while absorbing the highest quarterly fuel expense in our history, reflecting broad demand strength, growing brand preference and momentum. Stephen Trent of STT Capital Advisors joins us now for more. Stephen, good morning. Good to see you.
Good to see you. Thank you for having me.
First reaction, sir, to the numbers we got from Delta earlier on this morning. What's your takeaway?
Yeah, look, I think the numbers were solid from a fundamental perspective. They did $1.56 per share. That was a penny above our forecast. It was 6 cents above the street. Unit revenue was very strong. And I think that's the story people are talking about. Are these carriers maintaining demand with everything going on? Are they able to raise unit revenue enough to offset what's happening with jet fuel kerosene? I think the answer is yes. The action in the pre-market suggests something a little different, and perhaps elements of the street were looking for a guidance increase, which didn't happen.
Don't you think it's impressive they were able to maintain guidance, given they, in their own words, experienced the highest quarterly fuel expense in their history?
Absolutely. I think from a fundamental perspective, the numbers look very good. The guidance looks solid. You know, $6.50 to $7.50 a share is above the street at $5.97, and we're actually a little bit below consensus. So that in itself was a feat. You know, if we go back 2 months ago, 3 months ago, I think the street was looking for big guidance cuts. You know, what's going to happen with fuel? They'll raise fares too much that it's going to start hurting demand. We start getting into these subtleties of the K-shaped economy. You still have premium and co-branded card remuneration outstripping main cabin. And I think that's the driver. And that's going to continue to be the driver.
Yeah, how much can that continue? I was looking actually that passenger revenue came in light and everything else beat. And the reason why you can have the bread and butter of the business, which is passenger tickets, not beat and still have a massive profit beat is because of American Express. It's because of some of these other partnerships that have lines of revenue. Is that getting to be kind of the driver of profits going forward? I mean, I know it's not the major driver, but how much do you see that as sort of the make it or break it of which airlines are successful going forward?
Yeah, absolutely. I think that is a key point. The 16% growth in American Express co-branded remuneration over the quarter is a big deal. I believe around the order of $2.4 billion in the quarter. So premium passengers are still the anchor. You have the top 10% of U.S. consumers basically driving all the demand. And not all of that demand is coming in premium cabin versus main cabin. Exactly, you just said, a lot of it is now coming from co-branded and loyalty. And I think if you're a network airline versus a discount airline, that's exactly how these carriers have been able to de-risk their earnings streams since COVID. If you look at what they've done in cash flow from ops, there's been a massive increase in their cash flow from ops.
What does that mean for the discount airlines, for the likes of Frontier, for the likes of JetBlue?
Yeah, so, we think it's a tough one for them. You look at what's happened versus 2021, for example. Frontier's cash flow from ops is down 85 some odd percent if you look at its latest 12 months cash flow from ops versus 2021. And that's in nominal terms. Southwest is up a mere 3%. So if you inflation adjust, that's also down. You look at United, on the other hand, up 360%. American Airlines up 591%. So this whole thing we've been seeing with premium driving the train, we've seen this broadly in earnings wallet share. The network airlines now are practically driving all the earnings wallet share. Okay, Southwest is still profitable and Frontier is improving, but they're not nearly as strong as the others. So I think that's exactly the reason you're seeing the likes of Frontier and others trying to add premium. Are they going to add enough premium? Are they going to add enough co-branded card like United Airlines? I don't think so.
Well, and can they get the corporate clients? I mean, that's the other issue, because corporate really drove a lot of the earnings that we saw from Delta. Can you get that kind of relationship if you don't have the footprint and, frankly, you don't have the same type of longstanding reputation?
Yeah, I think that's exactly it. I think it's really hard. If you don't have the premium lounges at the airport, you don't have global capillarity, both directly and through global alliance partners, and a long history of premium cabin. If you've traditionally been a domestic airline that had sold discount seats pre-pandemic, it is very hard for you to become that different animal. So I think the path is going to be challenging for the discount airlines versus the network carriers.
That raises a big question. You're not in the stuffy seat over at a bank anymore. You've got flexibility to tell us what you think about the world. Apollo versus Castle Lake for EasyJet. It's not a name you've covered historically, but what kind of business are these guys getting themselves into? What's your message to them?
Yeah, that's actually a little bit of a tough one. I mean, airlines, generally speaking, are, they're dangerous, no? I mean, on the surface, they're simple businesses. So everybody thinks they understand how the businesses work. But getting down in the weeds and the subtleties and the way these things trade and the undercurrents that I was just mentioning about premium and co-branded can get really choppy. So I've seen over the years, private equity get burned. Maybe you have some instances where you've had some really powerful activist shareholders come in and do a reasonable job in terms of share price reaction. You can say that, for example, with Southwest, even though Southwest is still not getting the job done in terms of their cash flow from ops. So this EasyJet thing, I saw the headline. I would advise them to proceed with caution. This is a tough space And that's a tough segment of the market as well. Maybe if we were talking one of the network carriers, I'd be a little more comfortable.
What's one of the headlines? What's one of those quotes? The best way to make $1 million, start with $1 billion, buy an airline. Right? I forget whose line that is, but ultimately, that's how tough that business is.
Yes. I like that you have no opinions.
I got no opinion on this.
It was very clear. I love the way that you asked these questions. You're like, what are they getting? What would your message be? And Stephen's like biting his tongue. Like, what are you thinking?
He told us what he thinks.
Exactly.
It's a really difficult business.
Yeah, I mean, we see that time and time again, and especially if you're trying to break in against some of the behemoths in the industry.
You ask people what their favourite airline is, they give you the same answer all the time. It's Delta Airlines. I like the stock.
Delta and United.
Right?
Those are the two.
You've got a different view, though, and I wanted to finish there. Your top picks in this space, it's not number one, it's not Delta. It's something else. Why?
Yeah, we're like a modest overweight in Delta. Kudos to them. Great airline, but it's harder for them to surprise the street versus others. I think the pre-market activity is showing exactly that. The one we like the most is Copa Airlines in Panama. And if you look at Delta doing a low double-digit margin on 2025, for example, EBIT margin, Copa's EBIT margin is in the low 20s. It's levered 0.6 times. It's got a 4.5% cash dividend yield. And in a lousy year, it's going to do $200 million in free cash flow. So for an airline that has, a little more than 100 planes in its whole fleet, we think it's got a moat around its main hub down there in Tucumán Airport in Panama. So this is a carrier that, within the aviation group, comes as close to we see as buying it and going to sleep well at night, which is impossible in aviation, but I'm saying it gets close.
I have no doubt that that's now under Lisa's coverage. And that she's already looking for flights to Panama.
St. Andrews State Park, Sea Dragon, Pirate Cruise.
There we go.
I'm looking relaxed on the stunning beaches.
Appreciate
Dolphins.
it. Stephen Trent, STV Capital Advisors. It's just depressing. All these great places Bramo gets to go.
I'm going to Atlanta on Monday, please.
Okay. What's wrong with Atlanta?
Absolutely
Fantastic
nothing.
barbecue.
Fantastic.
What's wrong with you?
Barbecue.
Yeah, good food.
Oh, really?
Yeah.
Have you spent a lot of time
I'll give you
there?
some places. I've been a couple of times. I'll give you some places to go. Yeah, sure.
Please, that would be great. No,
Without
actually, no, look, I'm not going to do a channel check, although if you're going to invite me to Panama. I do think it's interesting. South America definitely getting a lot more clout, especially as people try to go there more. And you see that in the business routes, too, because sometimes these routes actually track where people are thinking about trade and business partnerships increasingly in South America.
The Brit telling the American where to go in the
I know,
South.
love this. This is great. This is fun.
All right. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Anthropic appointing former Fed Chair Ben Bernanke to its long-term benefit trust, a governance body designed to safeguard the startup's public interest mission. The trust will advise management on decisions around AI risks and impacts. S&P Global downgrading Oracle's rating to BBB-, one level above junk, citing the company's growing spending on AI. The agency says Oracle's rapidly expanding infrastructure business is increasing its overall credit risk. Netflix is looking for ways to increase subscriber engagement. The Wall Street Journal reporting the company is considering adding live channels that would continuously stream certain programs. Netflix is also exploring bundling other subscription-based services. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. I'm next on the programme. Regime change at the Fed.
I'm appointing a task force in each of 5 areas. That'll be taken up by the task force. We've got a task force for that. I've been on a task force or two in my life. It's one of the things we have a task force to do.
Ed Al-Hussainy of Columbia Threadneedle joins us next. Stocks negative by not even 0.1% on the S&P. We're down 1/3 on the Nasdaq 100. SK Hynix making the headlines, coming out with an equity offering, raising 26.5 billion.
Yep, biggest ever.
Record for a foreign company tapping the US equity market. Let's turn to the bond market, a more discerning fixed income investor that we can talk about. The 2-year, 417.65, 10s at 455, 454. We've had a lot of debt issued this week on both the sovereign and on the credit side. And on the credit side, don't forget Amazon came to market this week and got a bit of pushback from credit investors.
Yeah, people forced them to both pay up and potentially they weren't as interested. There was only 2 times oversubscribed versus, say, 5 times oversubscribed earlier this year. How much is this an Amazon issue? How much is this a broader pushback? Not necessarily saying that the market is closed in any capacity. Still plenty of money willing to put to work, just for a higher cost. And that, I think, is important both for the corporate issuers as well as the United States.
We'll buy your debt, show me the yield. That's the story right now. Heading into next Tuesday, CPI and Fed Chair Kevin Warsh on deck in just a few days' time. Under surveillance this morning, regime change at the Fed.
I'm appointing a task force in each of 5 areas. You'll hear quite a bit more about these task forces. That'll be taken up by the task force. We've got a task force for that. The good news for you is we have a task force for that. We have a task force on that too. I've been on a task force or 2 in my life. It's one of the things we have a task force to do.
So here's the latest this morning. Fed Chair Kevin Warsh following through on his word, creating 5 task forces set to look into how the central bank can improve in very specific areas. Among those appointed, 3 former policymakers, as well as the former Walmart CEO, Doug McMillon. Ed Al-Hussainy of Columbia Threadneedle writing, markets are attempting to balance 2 caricatures of Warsh's thinking. His silence has left a vacuum that will be filled by other speakers who have largely inched closer to tightening policy. Ed joins us now for more. Ed, good morning. Good to see you.
Good morning.
Let's start about the task forces and the individuals on it. What are you expecting to come out of all of this?
I think the task force I'm paying closest attention to is the balance sheet. I think that's clearly an area where the Fed is ripe for reform. It's an area where Warsh has focused a lot of his attention in the course of the past several decades at this point. And I think it's the area that's going to have the most salient impact on markets.
So Karen Dinan, Raghu Rajan, Jeremy Stein, what do we need to know about these 3 people?
I think relative to some of the other appointments, these are much closer to the academic side. Stein was involved in formulating the quantitative easing program under Bernanke. And so deep expertise, academic expertise, and of course market expertise. He's been a market participant for several decades as well. So a very deep pool of expertise coming into that area. And I think people who've had, again, quite strong opinions about how the balance sheet should be reformed.
At the same time, I think some of the other task forces have gained a lot of interest simply because some of the non-traditional central banking type figures have been put on them. I'm thinking of the data task force with Doug McMillon, the former president of Walmart, or, for example, what we see with productivity and jobs, the idea that a Microsoft executive and Mark Andreessen are among those on leading the task force. What do you make of that? Sort of a different type of voice playing a big part in this.
Yeah, look, I think it looks like they've cast a really wide net. As a market participant, I think what, again, I'm most focused on is where is this going to translate into an impact on bonds? And clearly, the balance sheet is closest to that. Communication is probably a second. The rest of it is extraordinarily loose and a very wide mandate. So we'll have to see what comes out of that.
Do you think that because these task forces are ongoing, that Fed Chair Warsh has bought himself time to really make any kind of major move? Or do you think that this is a Federal Reserve that's going to be swayed by those that are speaking most, the other central bankers that are increasingly concerned about inflation?
Yeah, I think the focus in the near term is squarely on monetary policy and what do we do with respect to inflation. I think it's a matter of having a conversation about the next several meetings, whether they are live.
Are they?
I think they are. I think the minutes made it quite clear that the majority of the committee has moved in that direction. And then the question becomes, look, if we embark on a tightening process, how do we calibrate it? How far do we have to go? This stuff works, obviously, with a lag. Once you abstract from that, you're left with the balance sheet. And the balance sheet, again, is going to be central. How much room to maneuver do you have? I think it's going to be quite limited. And then the rest of these committees, I think, might have an impact in the more medium term.
Ed, what do you believe has prompted that shift? For quite some time, this Fed believed they were sufficiently restrictive. So much so, they believed they could address labour market weakness by reducing rates by 150 basis points over the past few years. So what prompted this change?
Look, I think they got it right. They lowered policy. Labour markets have stabilized. And then they got unlucky with respect to the quantum of inflation that's still left in the system, about 100 basis points of inflation. It turns out that that inflation is largely interest rate insensitive. It's largely insensitive to the decline in the wage story. And now we've had some new shocks in the form of tariffs, in the form of energy, and a little bit of AI demand. So they've run out of luck this year.
So what do you achieve with a 25 basis point hike?
Nothing.
A second or a third? What does it do?
I think this is where guidance is important, because it's a force multiplier to the extent that you can move markets. And look, let's take a step back. Markets have priced in much tighter monetary policy. The inflation-adjusted two-year rate is up about 175 basis points from the lows this year. You know, that's a significant change in the Fed's posture that's currently priced in. Is that enough? Probably not. As a rough rule of thumb, you can think about them having to unwind the cuts from last year, so it's about 75 basis points. We have somewhere between 1.5 and 2 in the price at the moment.
What would cause the meetings, whether it's later this month or whether it's in September, to truly be an actionable meeting when it comes to the CPI and other data that we're getting? Do you have sort of a threshold that could potentially make the difference?
I think this is where it's really interesting. So in the last several years, because the starting point of monetary policy was quite tight, there was consensus in the committee, we're starting from a pretty tight place, the incremental data carried a lot of weight. You could calibrate how much easing you want to do based on incremental data. Most of that data was on the labor market side. This year, in some ways, the incremental data is taking a little bit of a step back. It's the overall state of play. In other words, you hear this reference, inflation's been above target for 5 years. Well, the next several months of data is not going to change that fact. If the animating feature here is we want to assist inflation in coming back to 2% over the next couple of years, the next couple of months of data becomes irrelevant.
Ed, it's good to see you. Thank you, buddy. Appreciate it. Ed Al-Hussainy there of Columbia Threadneedle on this Fed meeting, and those meetings are live, according to Ed, in the coming months.
Yeah, adding some more confusion, though, to the reaction function. Again, this goes back to people not knowing exactly what the threshold will be or what will make the difference. You asked the question, what caused the shift for the likes of John Williams to come out earlier this year saying that he still sees disinflation, to suddenly, a couple months later, saying that inflation is likely sticky and coming more from AI than even energy prices. Again, a massive shift, leading a lot of investors to say, where is exactly the trigger point to potentially take action?
You're expecting clarity on that from Chair Walsh next week in his testimony?
Full clarity. I expect full treatise with lots of descriptions that are not at all related to task forces or the weather.
Scenario analysis and real depth.
No, we're not going to get anything.
Okay.
Maybe we'll get something.
We'll be taking it live right here on Bloomberg TV. I believe it probably will. So tune in for that. Tuesday morning. There you go. There you go. Coming up next, Sonders of Charles Schwab, Jay Goldberg of Seaport, Nancy Lazar of Hyperscalers, Jonathan Krinsky of BTIG. We appreciate the honesty, Bramo. The honesty.
Good.
The demand for stocks remains very healthy.
When there's a lot of enthusiasm, people tend to get a little bit ahead of themselves.
If that falters, I think we've got a real problem on our hands.
You have to be prepared that this could shift, and it could shift very, very quickly.
The summer's going to be volatile. This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. You're almost there, Bramo. 1 hour to go.
I love how you just blame me all the time.
I'm almost there. 60
Thank
minutes
you.
to go. Weekend's just around the corner. Equity futures on the S&P negative here by 1/10. We're down by 0.4 on the Nasdaq. Still heading towards a weekly gain on the S&P 500, the second consecutive weekly gain. Into the airlines we go. The earnings begin. Delta Airlines a little bit earlier on this morning, reaffirming guidance following a really big run up in the stock. Lisa mentioned it a few times this morning, up by close to 30%. Year to date, down to this morning, down by 0.75%.
Is this a sign of what's to come? And we get earnings next week, kicking off with the big banks, JP Morgan leading off. And a real question is, how high is the bar for them to outperform? And of course, that is amid a question about whether we're seeing an earnings bubble, an earnings expectation bubble. Delta did deliver, despite the fact that oil prices were substantially higher, and they faced the highest fuel bill ever in their history. They still were able to overcome that and still maintain their projections, seeing increasing revenues coming from premium, coming from their American Express partnership, coming from some of their corporate travel. Does this sort of indicate how much investors need to see something absolutely astronomically phenomenal for them to buy up stocks that already are rich.
We've just worked through a really positive earnings shock, and the bar is reset higher. It's much, much higher going into earnings season this time around. Talked lots about the consumer. This drop from Bank of America moments ago. Heading into the summer, consumer spending momentum was very strong. Total credit and debit card spending, based on their data, rising 6.3% year over year in June. That's pretty punchy stuff.
And we're seeing confirmation of that, the likes of Delta. At the same time, then you have Pepsi. They came out yesterday and said that they are seeing pressure in the lower income consumer. How much can Wall Street continue to lean on the higher end of the income spectrum to support the consumer in a time when there is this increase in K? Right now, quite a bit, and that seems to be the tone coming from Wall Street.
The increase in spending growth, almost entirely a discretionary story, driven by online promotions and the FIFA World Cup.
Well, yeah. How much are we going to be getting?
A bit of a bounce there.
Increasing. Yeah. Although we were asking, were people going to show up? Were people going to spend the money on the tickets? And it turns out
they did.
They did.
I think it's great news. Fantastic.
Yeah. Are you going?
No, because I can't afford it, Bramo.
Well, that's what
we're talking about. How much is it to go to the final? We're in New York.
You think I've checked?
I checked a few months ago.
Yeah, what was it?
I think sure get in is probably like cheapest tickets, probably 10K.
All right, well, write in your responses, and I'm going to look in a second, and then we'll reveal it at the end of the segment. We'll reveal how much it costs to attend the final.
Everyone's going to stay tuned for that and not look at it themselves, right? On Ticketmaster. Stay tuned. Bramo's got it for you in just a second.
Just wait, hold on.
Equity futures on the S&P, negative by 1/10 of 1% on the S&P 500. Coming up this hour, we'll catch up with Lazar Sonders of Charles Schwab, with stocks eyeing a second straight week of gains. Nancy Lazar of Piper Sandler on why the Fed faces an uphill battle on inflation, and Jonathan Krinsky of BTIG saying chip makers could fall another 25%. We begin this hour with stocks pulling back as markets await the US training debut for SK Hynix. Lazar Sonders of Charles Schwab writing the following: stay in gear with AI theme by avoiding crowded direct plays and leaning into less crowded derivative plays. Lizanne joins us now for more. Lizanne, welcome. I just want to take you from the start, from the top, and I want to pick up on something I heard you say earlier this week, that unlike what we saw more than 25 years ago in the dot-com bubble, that this time the bubble might be in the earnings and not the price. Lizanne, can you flesh that out for us? How different are things now versus then?
Yeah, and thanks for having me. I think maybe not the earnings where we stand right now, but the earnings expectation is, I think, where there could be a bubble. And I think we got a little bit of a flavor of that with the recent Samsung report that pretty nicely beat the sell side estimate. That's the consensus that analysts publish. But there's also a buy side estimate out there, and that's not something published. It represents maybe the whisper number or the hyped up number and the higher bar. And we saw what happened to the stock. That is one of the things I'm paying close attention to during earnings season, is whether that sell side versus buy side estimate has a very wide spread, and what's the sensitivity in terms of the market reaction. I think it probably continues to fuel these rapid fire rotations that just have become the name of the game in this kind of market.
Do you expect that to be a recurring theme across earnings season or just in select industry groups?
I think probably select industry groups. I think in those higher beta segments like tech and comm services, anything AI related, I think you have that wider spread between the sell side and the buy side. But we're seeing just a huge increase in dispersion. I think Kevin shared a chart with you guys this morning that shows a record spread between a relatively subdued VIX and that dispersion. You're seeing it in terms of the retail trading cohort. The turnover has never been higher. They're a little less active in individual stocks and more on the thematic side of things, as well as ETFs. But the dynamics of how the market is trading, who the players are, and the way they're attacking this has also shifted quite a bit. And it's just a different backdrop than what might be defined as a normal sort of earnings season backdrop.
Is it healthy? I think that's what a lot of people are wondering. Or does it signal, Lizanne, that potentially you could see some sort of crack if there is this incredible churn under the surface in specific name volatility?
The churn is not necessarily detrimental because it can lend support when you get some of the leadership names pulling back. When we saw the big bout, in many cases ongoing bout of underperformance by a cohort like the Mag 7, you saw a lift in other segments of the market, in industrials, in healthcare at times, and enough underlying strength amid this rotation, not to mention the intra-sector, intra-industry rotation. So I think the base case is probably a continuation of this type of a backdrop where you don't see an aggregate whoosh down on the part of the indexes, but a lot of churn under the surface. An example is the Nasdaq's up 13% year to date. The average member maximum drawdown within the Nasdaq year to date is negative 40%. So that's a sort of the poster child for that type of activity.
Perhaps a bigger question for a lot of people is whether this signals an exhaustion in some of the tech names and potentially that rotation that we saw try to assert itself before the reignition of the conflict over in the Middle East. How much do you see that as a path of travel in the last 6 months of this year? The idea that people will go into other names, expecting them to benefit from AI efficiencies and other types of growth, and maybe fade what we're seeing in some of the tech names.
Yeah, I first of all, I do think it's a tricky trading environment, and at least our message that we impart to our $13 trillion worth of individual investors is to not necessarily think that the only way to perform well in a market like this is to try to get ahead of these really short-term rotations. There's so much short attention span money in the market, and maybe it's a little more boring to talk about or to think about, but I think the diversification story is more powerful than it's ever been, particularly within asset classes and even within sectors. But then consider portfolio or volatility-based rebalancing. A lot of rebalancing gets done based on the calendar. It might be quarterly, it might be annually. Move away from that calendar-based rebalancing and take advantage of these rapid-fire rotations by, adding low and trimming high a bit more frequently and stay in gear that way, as opposed to trying to get ahead of some of these short-term trade.
Lizanne, I wanted to pick up on something that you've noted. We often talk about these short-term tactical rotations, these shifts in the market, and we point to small caps. Small caps will have its moment. To your point, small caps has been having its moment for quite some time now. What's been driving those gains?
So, there's been different forces driving small caps. And you're right, John, it's been the trailing 2-year period that Russell 2000 is pretty handily outperforming the S&P 500. So this is not some new story. A couple of years ago, I think the impetus for the initiation of that outperformance was a move by the Fed toward easier monetary policy. Of course, we've had fits and starts with that. Almost 2 years ago, the Fed embarked on an easing campaign after 3 cuts that included a 50. They had to pull back because the economy accelerated again. Same thing happened last year when the Fed embarked, but then you had the much more sticky inflation problem driving that. And I think now the story is one about opportunity, in that let me look beyond just the mega cap AI plays and look for opportunity. And you're finding in other areas like healthcare and like biotech and smaller names. But what I would say about the small cap space is last year was a year where the non-profitable components of the Russell 2000 had double the performance of the profitable components. It was up 20% versus up 10%. That is starting to shift this year, and you're seeing this convergence where you now have a little better performance on the part of the profitable. So that's the way I'd look at the small caps. I would sort of lean into the profitable side, the higher quality, the high interest coverage and strong cash flows, and fade the non-profitable, lower quality segment.
Lizanne, this was great. Really thoughtful stuff, as always. Lizanne Sonders there of Charles Schwab on the equity market. The enduring outperformance we've seen in small caps over the last 1-2 years relative to, say, the S&P 500. And the cost of everything right now, Bramo, you want to go there?
Of course.
Go on. Let's get to the price. What's the get-in? Nosebleeds at MetLife.
True.
World Cup final.
True nosebleeds. I mean, actually,
like
your nose is going to be bleeding because
row.
You are actually standing up on the press, like on the top. $7,576. That is how much to sit on the roof, to essentially sit and kind of try to see if there's anyone playing. If you want to get really close to the field, you can spend $70,000. And then if you want to spend $70,000, yes, just to sit in a seat that's relatively close.
And this is not
to the
MSG.
field.
Let's sort of frame that out. We're talking about 5x the capacity. What is it, 82,000?
I didn't check the capacity, but yes, it's a massive stadium, football stadium that you normally would see completely packed to the gills, and the amount of money they're bringing in case that's not enough. you could buy food. I mean, things like $75 caviar-topped tater tots.
Oh, right. That's once I've paid 70K, Bram, I expect the food to be free.
You expect your caviar-topped tater tots to be delivered to your seat.
That stuff needs to be free.
Or how about a Twinkie cheeseburger for $22?
That sounds gross. That really does.
That's welcome to America,
Yeah,
John.
that's. I love America, but that does not do it for me.
Not a Twinkie cheeseburger.
If we get
kind
a
of guy.
blockbuster final like Argentina versus France,
Then you'll eat a Twinkie cheeseburger.
No, I was going to say that 7.5 won't be the get-in price.
That's true. This is for now.
Yeah.
Just wait. So if you want to get in, it's a hot deal.
Right. Once the real fans who are price insensitive and just ready to go to the final.
Yeah.
Once their team gets there.
I don't know how many people are truly price insensitive at this kind of level. But nonetheless, it is bolstering consumer spending, which brings us back to our story, which is resilience.
I'm impressed by how many people can afford to go and travel the States for a whole summer and go and follow their country.
I've seen them. I think it's wonderful. I think
remortgage the house.
And I mean, frankly, they've bought out the beer at certain kinds of bars and
good for them.
Been able to take road trips.
Spend 4 years paying for it and then do it all over again.
Yeah, that's understand the living of life, right? So it's like work to live rather than live to work.
Something like that.
Yeah, exactly.
Okay, I respect that. Futures this morning down by 1/10% on the S&P with an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. New comments coming out of the Middle East. Iran vowing to retaliate in response to attacks on its infrastructure. In a statement, the Supreme National Security Council saying Israel, quote, which is behind these wicked acts, will not be safe from the response, unquote. Boeing opening a new 737 MAX assembly line at its Everett, Washington facility today. Sources telling us here at Bloomberg the line will produce mostly wide-body models. Boeing is looking to pay down debt and boost output. And Micron is increasing its spending on new plants in the US to $250 billion to help meet unprecedented demand for its memory chips, fueled by the AI boom. The plan adds $50 billion to a prior commitment on expanding domestic chip making, including projects in New York, Idaho, and Virginia. That's your Bloomberg brief. John.
Bonnie, thank you. Thanks for the update. Up next, the Morning Calls Plus, Jay Goldberg of Seaport on the concentration risk facing chip stocks. That conversation just around the corner. Live from New York City this morning. Good morning.
All anyone needs to do is look at some of these charts that have gone completely hyperbolic. Quite frankly, folks extrapolating the sustainability of pricing. We can absorb, a 10, 20% decline in semiconductors and not have a lot of damage to the headline index.
That was Lisa Shalett of Morgan Stanley. Her message pretty clear. Get out of the semis, the chip makers, get into the hyperscalers. Her message throughout this week. Equity futures right now in the S&P, unchanged on the S&P. On the Nasdaq, down by a third. Pretty punchy stuff from Lisa Shalett. Her message quite clear. Do that. Don't wait for a reduction of capex to make a move.
Her spidey senses are up. She got something from Meta, and she said that it is telling a very strong signal that there is going to be some sort of reduction in capex, and you're starting to see the whisper of it. And if you wait until you get the confirmation, it's going to be too late. I wonder how much, to sort of reiterate what she said also about what that means for inflation, whether we've seen the peak in AI inflation or the rate of increase in prices, and whether you're going to start to see more moderation there. Really interesting for a broader story.
The deceleration in spend that she's beginning to sense. Lisa Shalett there of Morgan Stanley. That's some of the price action, some of the calls. Let's get to your morning calls. First up, Citizens cutting its price target on Meta to 800, saying it's on track towards competing with leading AI labs. That stock is up by 3%. Your second call from Susquehanna, initiating coverage on IBM with a neutral rating and 303 price target, seeing, quote, so many reasons to like the stock. And finally, Stifel raising its price target on AMD to $635 from $450, saying the slide in chip makers is more of a valuation reset than a fundamental slowdown. AMD is down this morning by 0.5%. That three your morning calls. Let's get to SK Hynix. The ADRs begin trading on the Nasdaq today. The company raising more than $26 billion, the largest first-time share sale by a foreign company in US history. Bloomberg's Ed Ludlow joins us now for more before he heads off to the Nasdaq. Ed, good to see you. What do you make of the issue?
Yeah, look, there's clearly demand, heading towards $200 billion of demand for a $26.5 billion deal. When we talk about it being oversubscribed. That's how I'd frame it in the dollar terms. And clearly they need the capital, right? They are committed both in Korea and probably here in the United States to building out memory capacity. They have a 57% market share in high bandwidth memory. But right now, you just take the memory market in aggregate, HBM is like single digits, but because of the pricing in dollar terms, it's so much bigger than that. So they're going to have to work out their capital strategy. But really, it's about getting in front of the American investor that SK really believes understands the AI story better, because this is where so much of the AI story is playing out.
Ed, it's hard to make that argument when you've seen the run-up in South Korea over the last year, no?
Yeah, I mean, the Korean market has been volatile, and even in the short term, in the last week, that volatility doesn't seem to have dissuaded the appetite of US investors. What's interesting about SK in particular, right, is if you think about fund managers around the world ex-Korea, it's very difficult for them to access that market. It was a very conscious decision for SK to price the ADR at a premium to the Korean shares, but they felt confident that they could do that, tap the demand without leaving money on the table. So, yeah, I think that the idea is that if you think about SK's footprint, what is it they got going on in California? They have their sales channels there, and they have their R&D there. Their biggest customers are there, NVIDIA being king among them. So it is about being in front of the American investor, but also the companies that are driving the infrastructure build-out where that high bandwidth memory is going.
The records keep dropping. Ed, thank you, buddy. And looking forward to the conversation later this morning, 10:30 Eastern Time, from the NASDAQ, the SK Hynix chairman catching up with Bloomberg's Ed Ludlow. Look out for that and more coverage on Bloomberg Tech a little bit later this morning at 11 a.m. Eastern Time. Let's build on this. Jay Goldberg of Seaport writing the following. The entire AI trade is driven by spending from 7 companies. So long as they keep spending, semis will see earnings growth. But any hiccup and the stock market gets spooked. Jay joins us now for more. Jay, welcome. Do you sense any deceleration in spending on the horizon?
I don't. Now, in all fairness, I'm not a hyperscaler analyst, so I don't have the contacts at Meta and Google and Amazon that some others do. But certainly what I'm seeing from supply chain and from people in my community locally in the Bay Area, there's no slowdown in sight.
So do you think that, Jay, what we've seen in terms of the valuation reset or the sell-off in semiconductors is creating an attractive entry point? Or do you think that ultimately there's something else driving some of this activity?
I think your previous guest, Lizanne, had it right. It's a very confusing time. It's a really difficult trading environment right now. If you look at some of the spending plans that are out there, and these are committed contracts that data centers that people are going to build, there's a huge, huge ramp starting next year, late 27, early 28. Numbers get really, really big. The problem is a lot of that is already reflected in the share price, and timing is always a little uncertain. And I think we have a situation where sentiment got a little ahead of fundamentals, and that was sort of the correction we saw, this month or last month. I mean, the way I sort of think about it, there are stocks in my sector which could double or triple from here. The numbers are that big. The problem is they could all trade down 50, 60% before we get there. So it's a difficult trading environment.
Jay, it seems like a difficult moment, especially considering that a lot of people are increasingly skeptical, and yet the market can continue rallying for longer than they can remain skeptical. As someone who does have a sell rating on NVIDIA and Qualcomm, and as someone who has been more bearish in some of the trades, how difficult has it been to remain bearish given sort of the freight train that seems to be recycling back in every time anybody sees any kind of dip?
It's tricky. I'm not universally bearish, right? I am picking my targets here. I have buys on AMD and Intel. I think both of them have pretty strong prospects next year. Intel is fundamentally re-rating. It's a company we'd left for dead 2 years ago, and has a new CEO and a new lease on life. And as you know, if you look at NVIDIA, it's the worst performing stock in the SOX index this year to date. So I've been saying all along, NVIDIA is going to underperform because we have a really good sense of where that company is selling, what their prospects look like. That's the most scrutinized company on the planet right now. I think that what we've seen this year is people have been looking towards other sort of less appreciated corners of the industry that are benefiting from this just as much.
Well, South Korea being part of that story as well, Jay, just to jump in. They've now got a listing here, ADRs. How do you think about that in terms of competition for capital in the sector with other names listed here?
I think it's a it's a big and growing issue in the industry. 30% of that AI capex this year is going to go to memory. It's going to be 40-50% next year. We're talking about $1 trillion of capex, and a very large portion of that is going to memory. It's a phenomenal time to be a memory company.
Right now, would you say it's the peak?
No. I don't think we get into supply-demand equilibrium for memory until 27 or 28. Calling memory stocks is very, very difficult. They're very, very cyclical. I think there's still a lot of room for the fundamentals, for the earnings to go up. How that gets reflected in the share price is difficult to predict.
That's the key phrase, Jace. You said it. You just said it. They're still very, very cyclical. Some people don't believe that. They believe the story's changed. Why do you believe that's still the case?
Every bubble somebody says this time is different. Look, there's obviously huge demand for memory, but at the same time, the memory makers are expanding very heavily, right? Micron is building 5 plants, 5 fabs right now. Hynix is raising a lot of money at this IPO. They're gonna plow that back into building more capacity. Samsung announced a massive investment plan a few weeks ago. So this is how these cycles work. There is lots of demand. They spend a lot on capex to catch up. I think the only thing that's different here is they have a lot of customers paying for it upfront, paying cash upfront. That levels it out a little bit. But there's a lot of capacity that's going to be coming online in 28, 29. We'll see what memory looks like then.
Jay, it's good to see you. Thank you, sir. Jay Goldberg there. Seaport, not bearish on everything, just super bearish on Nvidia. More recently, looking at 2028, when can you start worrying about a few years' time?
Yeah, I mean, ultimately, maybe not so optimistic on Nvidia, and we actually have seen an underperformance there. So to that, kudos to him for going against the grain and being the one sell rating, but also saying things like, this isn't my first bubble, and seeing a lot of analogs, at least earlier, when he's been on to the 2000s and what happened with Cisco. Here's the issue. There's clearly skepticism about how far the buildup can be, but it's been very difficult to time it, and you can feel that in all of our conversations with everyone who comes
Multiples are not excessive, which is why Liz Ann Sonders is asking the following question. Is there a bubble in earnings expectations?
Right. And
that's what we're trying to tackle.
And maybe we'll start to get some hint of that next week when we get earnings. Coming
up next on the programme, Nancy Lazar of Piper Sandler and why the Fed is a ways away from reaching its inflation target. Plus, Yahira this time has your morning movers. Delta are raising earlier gains. Their stock is down 0.9%. The open about 60 minutes away. Equity futures this morning just about unchanged on the S&P, softer on the Nasdaq. We're down by a third. No drama there. Let's get you some single names, some morning movers. Let's cross over to Yahira for more. Hey, Yahira.
Hi, John. Delta is giving back its earlier gain. Shares are now down 0.7%. The airline reaffirmed its full-year outlook with strong demand for premium seats, helping to offset the highest quarterly fuel bill in its history. But now investors are now asking whether that can continue, with fuel costs up 50%, according to CEO Ed Bastian. Turning to Circle Internet, shares are absolutely soaring, up 13% in the pre-market on news this morning that the OCC, that it won an OCC charter to launch a national trust bank. It's a significant regulatory milestone that brings more of the company's business under federal oversight instead of on a state-by-state basis. And investors see it as another step toward bringing stablecoins further into the traditional financial system, which is ultimately where the industry wants to go. And we end on Meta. Shares are up 3.4%, leading the Mag 7 and building on yesterday's gains on a new research report from this company, Semi-Analysis, arguing that Meta has the best chance at catching up to OpenAI and Anthropic. It points to Meta's massive AI infrastructure spending, projecting the company will have more AI computing power than its rivals by the end of the year. John?
Yara, thank you. Thanks for this morning. Better news out of Canada. That data just dropped in moments ago. 18,000 jobs added in June, a little more than 18K. The estimate was 10K. Unemployment dropping back to 6.5% from 6.6. The estimate was 6.6, so back down to 6.5%. Better news there. The reason I'm bringing this up is that economy has really struggled all year when their neighbour, southern neighbour, the US, has been absolutely flying.
Well, and it hasn't been totally without relation, right? I mean, a lot of people will say that a big part of the reason why the Canadian economy isn't doing so well is because of certain trade tensions that have curtailed some of these sales. Also, though, noting earlier this morning that inflation came in slightly below expectations. You're seeing some of these things kind of going the way of central banks around the world. Is this a sign of reset? A lot of people are saying that Canada had entered a technical recession.
Yep.
Was that going to be a brief type of issue that really wasn't going to be a prolonged downturn? This suggests maybe that's the case. That's your Canadian assessment for the morning.
That's the latest. That's the 60 seconds, right? Is that it? Got some more? No, you're done. Okay, you sound like you're really done. 28
I'm not
minutes,
really
Bramo.
done. Oh my
28
God.
minutes.
You are
all right.
so projecting.
Let's get the Bramo weekend clock
You
going,
are
all right?
literally projecting. But
I've been
carry
ready
on.
to look ahead to next week.
Yeah.
All week. Okay, so let's do that now. A blockbuster week ahead for the US economy. Inflation data just around the corner. All the big banks start to report on Wall Street. Fed speak and testimony from Fed Chair Kevin Walsh coming up on Capitol Hill as well. Look out for all of that. Joining us now to discuss, Enda Curran from Washington, D.C. Enda, let's talk about that testimony. What's the most we can hope for from Kevin Walsh in front of the House Financial Services Committee?
I think, does he give any clarity on his reaction function, John? John, that's what a lot of, I think, Fed watchers are looking out for. Yes, they kind of understand his argument and forward guidance. That's been articulated. People have their views on that. Some agree, many disagree. But the bigger issue, the kind of void when it comes to understanding the Fed under new chairman Kevin Walsh is what exactly is making him tick? How is he reading the economy? How would he respond under different scenarios over the months ahead? You know, to use the jargon, the reaction function. So I think people would like to hear him articulate some of that. They get where he's coming from. He wants less communication. He's trimming back on he's making changes where he can. But in terms of the core, what will be driving the Walsh Fed, that's probably one of the biggest talking points I think that people are looking for next week.
And what about these task forces? You've seen the names on it. Impressive list of names, I've got to be honest, to cover several stories at the Federal Reserve. What was your reaction to the list?
I think really significant and serious names, John, no doubt about it. You look through it, former policymakers like the Bank of England Governor, former Bank of England Governor Mervyn King, former Reserve Bank of India Raghuram Rajan. Then you have Karen Dinan from Harvard and the Peterson Institute, a well-known fiscal expert and economist. And of course, then you have the likes of Mark Andreessen from the tech world. I mean, it's crossing business and academia. It would be wrong to underestimate it. It is a signal of intent from Chairman Walsh. The question then becomes, where will this go over the months ahead? I mean, they've been set a pretty short time frame for all of this. Chairman Walsh said they're going to report back by the end of the year, and then those reports will go to the FOMC. So, it's a big statement. These are big names. But it's not yet clear where the process ends and what the deliverables will be out of it. That's, I think, what people will be looking for in the months ahead as this process goes on, John.
And thank you, buddy. As always, looking forward to your coverage from you and the team down in Washington, D.C. next week. Ahead of that testimony from Kevin Walsh, the Fed chair, we always get excited about these testimonies, and the same thing happens every single time. You get ridiculous questions in the House, things like, are you going to be a sock puppet? Remember that one out of the Senate Banking Committee last time, those kind of questions? Is that what we're going to get this time next week?
How are you going to remedy affordable housing? What kind of policy projections
all things
do you have
that are out of his control.
That are completely out of his control. How are you going to deal with AI power plants and what that's doing to pricing? I mean, things that he's not going to really have an answer for. That said, he's probably not going to have an answer for anything relevant either. So if someone asks a very good question, there probably is a task force for that. So, to the extent that I'm excited, it is.
It's probably a good thing for him that he gets those kind of questions, right?
Exactly. It's actually fantastic. But my enthusiasm is dramatically curbed.
Nancy Lazar of Piper Sandler looking ahead to next week's inflation data, expecting headline CPI to come in line with Wall Street estimates, but calling for a lighter read on core. Nancy joins us now for more. Nancy, welcome to the programme. If we get that, does that close the door on a rate hike this summer?
No, it really doesn't. The pieces of the CPI this month are going to matter more than what we've seen historically. By that, I mean, we do know technology has a bigger weight in the core PCE deflator. So how much of that, AI-related inflation does indeed show up in the CPI, then we have to pull it out and come up with estimates for what that's going to do to the core PCE deflator. In addition, you're getting bifurcation within I hate that word, but you are getting bifurcation within the inflation data. As you mentioned, headline is going to be down, probably both CPI and PPI, but the core components, again, you could see things that are incrementally sticky. The World Cup, you could also say the World Cup has added to inflationary pressures. Let's see if airfares go down. Let's see what happens to hotel rates. Let's see what happens to ticket ticket prices. And so we saw this a couple of years ago, where the internet entertainment space also could be an area of sticky inflation. And then last but not least, yesterday we also heard that the health insurance industry is going to raise rates double-digit, 15 to 20% in 2027. So I keep getting hit over the head basically by companies having more pricing power than we thought. And so, inflation, bottom line, is sticky. 1 month doesn't make a trend, and you have to really pull it apart and see where, there just continue to be surprises on the upside.
So bottom line, I hear hikes as you're speaking, Nancy. Do you see hikes in the future?
Well, my colleague Kurt Lewis, that's his focus right now, and he's reviewing. Reviewing that. To be sure, the interest rate structure is stimulative to the economy. I am a monetarist. Confessions of a monetarist. Money supply growth is reaccelerated. You're up almost to 6%. Bank loan growth is 7%. Why are you having that? Well, it's not because the Fed is tight. It's because the Fed is indeed been supportive of growth, and that's supporting obviously right now more so the high-end consumer than the low-end consumer. But if you can see some release on the energy side, then maybe even the low-end consumer can kick in. And then the next thing I have to worry about is maybe wage inflation, given the sluggishness in labor force growth and what we think is going to be stronger employment going forward. So net a healthy economic backdrop, and the Fed has really helped to support it through keeping the interest rate structure so low for so long.
So how excited are you, Nancy, to hear from Fed Chair Kevin Warsh on Tuesday all about the reaction function of exactly how the Fed's going to be handling incoming data?
So I'm not going to try to anticipate what he's going to say. I'm excited about the new Fed chair. The financial markets, if you look at gold, if you look at the dollar, are sending a lot of confidence in the path that he is taking. Status quo is not always good. Change is good, and I think the financial markets are embracing that, and they're impressed that he truly is taking control of the monetary policy outlook for the next many years.
At this point, we heard yesterday from the New York Fed president talking about John Williams talking about how he sees AI spend as potentially a bigger input to inflation going forward than even the energy side of the story. Do you think that that's an increasing concern? Do you think that that's valid and actually the potential driver here going forward?
So, yeah, absolutely. Right now, you've seen 20, 30% price increases from certain tech companies that will show up first in the CPI. And then, as I mentioned, have even a bigger impact on the core PCE deflator. Tech is almost 4 times bigger in the core PCE deflator than it is in the CPI. And so I think it is valid, but I would actually connect the dots. We had the tariffs that kept inflation sticky. Then we had oil. And we saw some pass through of that into other components within the CPI. Now we have tech and maybe something going on in healthcare. So to me, it's not just one, it's the path of companies having more pricing power than I certainly initially expected as we moved into 2026. And so bottom line is it's not just AI, it's a trend that we're seeing that inflation is indeed stickier. And as I mentioned, I'll say it again, I think next thing we're going to potentially have to worry about is wage inflation. There's not a lot of labor supply. I do think employment's going to get increasingly healthy, not as robust as we've seen in previous cycles, but unemployment claims tell us that AI is not destroying the labor market. Claims are down 8.5% on a year-over-year basis. And so are we going to next be talking about wage inflation?
Do you think monetary policy has contributed to these themes, Nancy?
Yeah, I do. I mean, I look at nominal GDP growth. Nominal GDP growth is what's actually calculated. We're paid in nominal dollars. Companies report nominal revenue growth, and it's nominal growth minus inflation that equals real. And nominal growth is 5.5, probably closer to 6%. Fed funds of roughly 360. That's a pretty healthy gap between the underlying trend in economic activity and the cost of capital. And so the Fed has certainly helped to engineer, positively so, a pickup in economic activity. Started with a high end. We hope now moving broader into the middle to lower income consumers. But absolutely, monetary policy has contributed to growth and now maybe incrementally to inflation.
So, Nancy, where do you think neutral is?
I prefer using this concept of nominal relative to Fed funds, and the bottom line is it's probably higher than what some of the Fed watchers think it's been. But at the end of the day, you have a 250, 300 basis point gap between nominal growth and Fed funds, and that is stimulative.
Nancy, it's good to see you. Thank you. Nancy Lazar of Piper Sandler wouldn't tell us she thinks this Fed's going to hike, but everything that Nancy said in the last 5-6 minutes just screamed rate hikes, didn't it?
Yeah, the Fed actually does have some influence over inflation, and you're seeing inflationary pressures from many different places. And she talked about wage inflation in particular. And yesterday, the Atlanta Fed put out their wage tracker, their wage growth tracker, and you did see a slight inflection higher. So job switchers, 4.1% from 3.7% in the prior month. So you are seeing a little bit of that around the edges, albeit 1 month does not make a trend.
Unemployment's at 4.2%. Inflation is the highest in 3 years. It's been above target for 5. No wonder there's additional pressure on this institution to be thinking about hiking and not cutting interest rates at this point.
You asked a good question, though, which is how much control do they actually have? And for every person we ask, we get a different answer. Some people saying that it's absolutely out of their control because the spending is rate agnostic when it comes to artificial intelligence. Other people, like Nancy, talking about the monetary supply and talking about how ultimately borrowing conditions are relatively loose as a result of where the Fed's at.
CPI on Tuesday and a much anticipated testimony from Kevin Walsh in front of the House Financial Services Committee coming up on Tuesday as well. Excited.
Really
yeah, I know.
You could see we're all going to learn.
Full coverage live right here on Bloomberg TV and the after show with Bramo coming up a little bit later that afternoon. I've made that up.
Drinks.
I made that
with
bit
drinks.
up. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. President Donald Trump firing 2 Democratic members of the U.S. Election Assistance Commission and a Republican resigning. It's the latest move by the president to put his stamp on how elections are run. Last month, the Supreme Court expanded his right to dismiss government officials. S&P Global downgrading Oracle's rating to BBB-, just 1 level above junk, citing the company's growing spending on AI. The agency says Oracle's rapidly expanding infrastructure business is increasing its overall credit risk. JP Morgan has built an AI agent that beat a traditional 60-40 portfolio in Mac tests. The results are based on historical simulations rather than live investing. And the bank warns that treating them as proof that AI can consistently outperform markets is not a good idea. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for this morning. Up next, we're setting you up for the day and a week ahead. And what a week ahead we've got coming up. Plus, we'll catch up with Jonathan Krinsky of BTIG saying the correction in chip makers could be far from over. That's next. You're watching Bloomberg TV.
That is one of the things I'm paying close attention to during earnings season, is whether that sell side versus buy side estimate has a very wide spread, and what's the sensitivity in terms of the market reaction. I think it probably continues to fuel these rapid fire rotations that just have become the name of the game in this kind of market.
That was Liz Ann Sonders of Charles Schwab weighing in on this equity market, framing things quite nicely this week. A provocative question compared to where we were more than 25 years ago in the dot-com bubble. The bubble then was in the price. She's asking now whether the bubble is in the earnings outlook. It's a worthy question, worthy of debate. Equity futures right now in the S&P 500 just about unchanged on the S&P. On the Nasdaq, we're down by 0.4% following a massive equity offering coming from SK Hynix in the last 24 hours.
Yeah, the biggest ever debut of a foreign company to the U.S. equity markets ever, $26.5 billion, upsized from the expected $24.5 billion, and coming at a premium to where the shares closed in Korea. Does this open the door to others? Does this highlight just how good conditions are for financing? You can take that whatever way you want, given the fact that companies are able to tap a wide open market, even with some of the skepticism that we're talking about.
Those ADRs begin trading a little bit later on today. That's the day ahead. This is the week ahead. The week ahead is basically Tuesday morning and a bit of Wednesday. That's basically it. On Tuesday, JP Morgan, Bank of America, Wells Fargo, Goldman, Citi, all reporting earnings on the same morning, 8:30 Eastern time. After all that's wrapped up, CPI data, and then, catch your breath, then Kevin Walsh testifies in front of the House Financial Services Committee later on that day.
Yeah, most important will be the earnings, because we'll get a sense of whether there is an earnings bubble or a bubble in earnings expectations just by the response in markets, as well as what the forward look is from some of these companies. That said, increasing questions around the reaction function of the Federal Reserve, so the 1-2 punch of both inflation and Kevin Warsh telling us all in this confession to the House Financial Committee will be really important.
I haven't forgotten that sprinkle of data on Wednesday, PPI on Wednesday morning, and got lots of friends over at Morgan Stanley. Always enjoy speaking to you, Ted. Morgan Stanley numbers drop Wednesday morning too.
Yeah, to sort of put a cap on what we get from the big banks. And ultimately, big question, will the IPO window and frankly the debt issuance window be as wide open in the back half of 2026 as it has in the front half?
But stocks so far this year up 25%. Morgan Stanley,
really well.
Goldman have done really well, given the backdrop for capital markets. Let's turn back to our top story on Wall Street. Investors awaiting the debut of SK Hynix on the Nasdaq today following a volatile stretch for chip makers. Jonathan Krinsky of BTIG writing, as US markets get ready to trade a new mega-cap semi, we remain cautious given the plethora of warning signs in recent weeks. Jonathan joins us now for more. Jonathan, welcome. Good to catch up with you. The warning signs, what have you seen in recent weeks?
Yeah, so I think the only thing more impressive than the performance of semiconductors of late has been that volatility. And we've seen, a host of signals that historically have been quite negative for the semis. So if we go back to June 16th of this year, you had a down 3% day for the stocks immediately following a 52-week high. That's been a pretty bearish signal over the last decade or so. Then on June 28th, you had a negative 7% week immediately following a positive 7% week. So kind of a whiplash on a weekly basis. We last saw that in March of 2000 at the dead highs of the dot-com bubble. And then yesterday was the 15th day in the last 30 trading days where the SOX has moved at least 3% in either direction, so up or down. The last time we saw that was, again, in the February to July 2000 period in the immediate aftermath of the dot-com peak. And then finally, we had a 3% up day that closed, this is a little bit technical, but it closed above its 50 and 200-day moving average, but below its 20-day moving average. And what that does, that isolates periods where you've seen a big rally, but within a primary uptrend. And when you look historically, that has led to some significant drawdowns, 95, 2000, 2004, 2007, 2020, and most recently in July of 2024. So you kind of add all these up, and it really just paints a picture that this increase in volatility is something that historically has meant further downside for the sector.
This sector went parabolic. You noted that several times over the last several months. You became cautious on the semiconductors. Jonathan, just looking at things and how they've corrected, we've come in now based on the recent rally. We're down about 11%, I think, from the June 22 high. You told us maybe a month or so ago that we would see an equal and opposite correction in that particular index. So with that in mind, is that still the case, Jonathan? And how much downside do you think there is?
Yeah, I think that's still the case. I think we held the 50-day, thought we might get a little bounce there, but I think there's still 20 to 25% downside for the index broadly. If you look at something like the precious metals, which went parabolic in a similar fashion at the end of January, it's only 5 months removed from that, and the silver's down 50% and is in a pretty strong medium-term downtrend, right? So I think people have short memories, and I think the downside is still pretty meaningful at this point.
Do you think that this is a downside that pulls other areas of the index down with it? Or do you think that ultimately it is just a big rolling ball of cash that goes from the semis to the hyperscalers and potentially to equal weight, and that we'll just see more of the same with a further downdraft in the SOX?
Yeah, so at this point, it has been rotational in nature, and I think that's the good news for investors. There's plenty of areas that are, breaking out of multi-year trading ranges. We've highlighted equal weight healthcare just broke out of a 5-year base. Insurance is broken out of an 18-month base. The REITs look poised to break out from 5 years of sideways action. So at this point, it is rotational in nature. I think the one risk we're watching is the correlation. The dispersion is so low. Or dispersion is so high, the correlation is so low, it's basically at all-time lows. That could become a risk as we get into the end of July or even August. And that's what we saw in 2024. Correlations were extremely low. And then once you kind of got through the rotation in the middle part of July, there wasn't anything left to rotate into, and that was what led to a bigger market correction. So I think that is a potential concern later this month or into the third quarter. But it's, at this point, we're still looking for that rotation.
How much pushback do you get on calls that are somewhat against the grain?
Yeah, the semis trade has been a very hot topic, right? I mean, I think there's people on both sides of the coin. I think the bulls will argue it is different this time. Our pushback is, again, the memory is so short. If you go back to May of this year, the hyperscalers and the Mag 7 were at all-time highs, and the thesis was very much that they were insulated to macro concerns. And then all of a sudden, 2 months later, we're talking about their CapEx going through the roof, and they're in a big drawdown. Just go back to software in October of last year. It was at all-time highs for the software sector, and by February of this year, it was trading down 30-40%. And so we just want people to keep an open mind. It could be different this time, but the gains have been significant. And again, when you get this host of sell signals, I think it at least warrants some caution and maybe hold off on some of that buying at this point.
Jonathan, it's good to see you. Jonathan Krinsky there of BTIG. It's been Jonathan Krinsky. Lisa Shalett of Morgan Stanley has warned about the same thing. Jay Goldberg of Seaport earlier on this morning. Bearish on some of these semis.
Yeah, and partly because people have just gotten so excited about it that maybe valuations have started to get a bit stretched, even as the valuations have come down. When you take a look at the hyperscalers, it is a relative trade as much as it is specific to semiconductors.
You made it, Bramo. Well done.
I love
You've
this.
done it. You've done it. We've made it to the weekend.
You have been projecting
I said we made it to the weekend.
That is your first acknowledgement.
Just excited about a weekend of football, all right?
Yeah?
Just very excited about a weekend of football.
Yeah, you're going to go right to the stadium. Shell out $10,000.
I am not. All right. Next week's a massive week. Here's the lineup on Monday. Jeff Yu of BNY, Sonal Desire, Franklin Templeton, Erica Najarian of UBS, Steve Pagliuca of Bain Capital. Get some rest. Have a wonderful weekend from New York City. This was Bloomberg Surveillance.